Welcome to Paycheck for Life, Acera's new and mid-career employee webinar. In this webinar, we're assuming that you're either new or you're somewhere in the middle of your career. So the bottom line there is that you're not yet near retirement, which is a good thing in the context of this presentation because it means you still have plenty of time to plan for retirement. So in this webinar, I'm going to tell you all the things that you might want to know about doing that retirement planning for the future. And since you're curious enough about retirement planning to watch this, you probably already have some questions. Questions like, what do I need to know about my pension? Do I need to do anything? And if there's something I need to do, what is that thing or those things? Well, I'm going to answer all of the questions that I think you're going to ask. I probably know about 95% of what you're going to ask because I've been doing this for a while. And I have arranged the information that I think you want to know into the form of this checklist. So these are the topics that we're going to cover in this presentation. I'll help you understand a little bit about retirement basics. I'll talk a little bit about pension math that Acera uses. You don't have to do any math. I'm just going to tell you what we do, and it's super simple. So don't get worried if you hate math. Part of that discussion, I'm going to talk about the retirement formula, and I'm going to talk about purchasing service credit. And then I'm going to help you get a precision pension estimate from Acera. So you can take a peek into the future and see what Acera is going to pay you in your pension in the future when you retire. And we'll talk about retirement eligibility and when you first become eligible to retire. We'll also talk about some additional benefits that Acera offers, including healthcare and death benefits. I'll talk about designating your beneficiary or beneficiaries for those death benefits. I will help you understand some career planning options. And what I mean by that is that at some point in the future, whether you work a long career here and go straight into retirement from this job, or you have a different plan, you have a different, job or set of jobs that you're going to do between now and retirement. What are your options regarding Acera for when you leave this job? So we'll talk about all of your options for that. And then that will lead right into making a retirement planning picture. So we'll take a little peek into the future and show you some tools that you can use right now that will give you a jump start on figuring out whether you need to save additional money toward retirement or not, and if so, how much to save so that it will put you on a retirement planning trajectory that will help you achieve retirement when you want or perhaps earlier. And as part of that discussion, we'll talk about starting a 457B account. So let's jump right in. First off, let me help you understand some retirement basics. Okay, so the easiest way to talk about this is to tell you first about Acera. So who is Acera? In one sense, Acera is this acronym. It stands for the Alameda County Employees Retirement Association. We are sort of a separate agency from the county, sort of part of the county, but our entire job, what we do is we provide retirement, disability, and death benefits to our members. That's you. You are a member of Acera, so you are part of the who that is Acera. There's about 90 plus of us that work here, and that's all we do is provide retirement, disability, and death benefits to you, our members. Now, since you're part of Acera, you're part of the who that is Acera, how did you get there? Well, you work or worked full time at some point in the past, but you had to at least start out full time in a retirement eligible position working for one of the six public agencies in Alameda County that uses Acera to provide retirement benefits to their employees. So if you work for one of these six places in that retirement eligible position and you had to at least start out full time, that makes you an Acera member automatically. Your membership is automatic and it's mandatory, so you don't really have any choice. As an Acera member, with every paycheck you receive, you make an employee contribution to Acera's fund. So if you look at your pay stub and you look in the before tax deductions column, you'll see a line in there. It might say something different depending on which employer you work for. This is a county pay stub, and it'll say something like retirement, and you'll see some money coming out of your check on a pre-tax basis, and that money goes into Acera's fund with every paycheck. And every time you make your contribution, your employer also makes a contribution on your behalf. Okay, so you're paying into the fund, your employer is paying into the fund. We don't want that money to just sit around and collect dust. So what we do is we invest it in a diverse array of investments all over the world with the goal of earning interest. And over long periods of time, we do earn a significant amount of interest. So it's these three sources of income, the fact that you're contributing, your employer's contributing, and we're earning interest on those contributions that give us this big pot of money that we administer that we call the Acera Fund. So why are we doing this? Why are we collecting all this money in contributions? Why are we investing it? What's our goal? Well, our goal is to serve you because while you work throughout your entire career, you are earning credit toward retirement. You're earning more and more credit the longer you work. And you're earning credit in three different categories. And I'll show you what those categories are when I talk about the retirement formula. But the longer you work, the more and more credit you earn toward retirement. And then the goal is that at some point in the future, you are going to stop working and you're going to retire. And you're going to retire from Acera. And at that point, you stop earning credit toward retirement and you start collecting on the retirement that you earned in the form of a monthly retirement allowance. So you're going to receive this amount of money every month through direct deposit to your bank account for the rest of your life, each and every month for the rest of your life. You cannot outlive your retirement from Acera. It's actually a beautiful thing. And in fact, pensions are special in that way because it is guaranteed income for life that you can plan on. And because the pension that you're going to get from Acera is calculated based on this formula that has these three factors in it that are data points from your career, it's very easy to get a precision projection on what that income is going to be in the future. So you can plan very precisely on what your future income is going to be from Acera, and then it's guaranteed for the rest of your life. So you cannot outlive your retirement, like I said, and private employers don't do this much anymore. So it's actually a special thing that you get to participate in a pension plan, earn credit in it, and receive that guaranteed income for life when you retire. Additionally, one thing that I like to point out is that because of the way that the system works, everything that you contribute in your employee contributions throughout your entire career, even if you work 30, 40 years here, we're going to pay that all back to you. All the money that you paid in throughout your entire career, we're going to pay it all back to you in your first 3 to 5 retired years. Okay. So in that first 3 to 5 years, you get all your money back. And then after that, let's say you live another, 15, 20, 25, 30, 35 years. It's like this amazing bonus that you get because we already gave you all your money back. But really, that's just how the system works. It's actually the investment earnings that pay for three-quarters of your lifetime pension. Okay. So that's kind of basically how this works. One thing that I do want to point out, going back to this one slide here, regarding this terminology, monthly retirement allowance, you'll probably hear me throw around a bunch of synonymous terms like monthly retirement allowance, pension allowance, pension benefit, retirement benefit. These are all synonyms for this same concept that we're going to that we're sending you money every month for the rest of your life in your retirement check, which is going to be direct deposit. Okay, so now that we got the basics out of the way, let me show you this pension milestone chart because I think this helps provide context for a lot of the different topics that we're going to get into regarding how Acera works. Um, and so these are the milestones regarding your Acera membership that you can expect to see throughout your career and your membership with Acera. So first off, you have your date of hire. This is your first day in that full-time retirement eligible position. Then what happens is for 4 of our 6 employers, 2 weeks goes by, and the first day of your second pay period is your date of entry into Acera. This is your first day of Acera membership. This is when you start earning the credit toward retirement. Now, for 2 of our employers, I think it's the Housing Authority and Livermore Area Recreation and Park District, there is no 2 week lag. So your date of hire and first day of work in that full-time retirement eligible position is your first day of membership in Acera. Okay, now you're an Acera member. What happens? Well, you start earning credit toward retirement. One of the 3 categories that you earn credit toward retirement in is basically time worked, also known as service credit. So if you earn 5 full-time years of service credit or the equivalent of 5 full-time years of service credit, if after you enter a SARA membership, you go down to less than full-time work, once you have earned 5 years of service credit, you're considered vested in the retirement system. Vesting, it's kind of a loose concept, but people use the word when they're talking about retirement. So I just kind of like to give you a kind of basic definition for it, which it kind of means guaranteed. So a vested benefit is a guaranteed benefit. Well, what happens at 5 years is you start being able to unlock the ability to collect the guaranteed benefits that you're earning in a SARA. So that's kind of what vesting means. Okay, now the next milestone is that some indeterminate amount of time goes by. And I say indeterminate because it's different for each one of your situations. There is a combination of years of service credit and your age that gets you to retirement eligibility. I'll show you what those combinations are in the second half of the presentation, but this is the first day that you could physically retire from a SARA because it's the first day that you're eligible. Now, many people do not retire on this day because the more credit you earn toward retirement, basically the longer you work, the higher that pension payment is going to be when you finally retire. So that's the goal of earning more and more credit toward retirement is getting a higher pension payment by the time you retire. Okay. So many people work past that, which is why I've left a gap between these two milestones. The next milestone is your last day on payroll with your employer, also known as your termination date. This is the day that you stop earning credit toward retirement. And then the next milestone is your retirement date, and this is a date that you choose. So you tell us when you're ready to retire as long as you're already eligible. And you'll notice that I've kind of overlapped these two milestones here, and that's because many people will go straight from their Acera covered position with one of our 6 participating employers straight into retirement. But many people do not. Maybe you leave your work here and you don't retire from Acera yet. You defer your retirement to a later date and become what we call a deferred member. That's totally fine. That is an option for you. And when I talk about career planning in the second half of the presentation, I will tell you the details of that you might want to know if that's your plan or if that ends up being what you do. So in that case, there would be a gap between these two milestones. Okay, so you can just imagine that. Okay, now you have your retirement date, the date that you choose. This is the day that you start collecting that lifetime retirement, that lifetime pension that you have earned throughout your career while you're working. You're going to collect it every month for the rest of your life until your death. That's when your retirement payments stop. But you'll notice there's one more milestone on the chart, and that's because at the time of retirement, you can name a beneficiary for what we call a continuance. A continuance is a continuing monthly payment after your death. And in most cases, it's going to be a lifetime continuance for your beneficiary. So if you die before your beneficiary, your retirement payments stop, and then we start paying a continuance benefit to your beneficiary, at which point, when they die, that's when their benefit payments stop, and that concludes us paying out all of the benefits that we owe to you and your beneficiaries. Okay, so those are the pension milestones. Let me just mention a couple of other retirement basics. I mentioned vesting. It kind of means guaranteed. A vested benefit is a guaranteed benefit. It happens at 5 years of service credit. That includes reciprocal service credit. And reciprocity is where you link multiple retirement systems, 2 or more retirement systems together, California retirement systems together. And you get some synergy by linking those together. I will tell you all about reciprocity in the second half of the presentation when I talk about career planning options. But for those of you who are already aware of it, just know that the 5 years combined of service credit among all the systems you have linked together gets you over that vesting requirement for the 5 years. And then the guarantee, where does the guarantee come from? It comes from state law. State law governs everything we do, tells us how to administer the benefits, how to calculate everything, and that provides the guarantee. So you're going to have these guaranteed benefits for life. And the main vested benefit is that monthly retirement benefit for life. A secondary one is an annual cost of living adjustment, which is a percentage increase that you get in retirement each year to your retirement benefit, your monthly retirement benefit. And then there's also a $1,000 lump sum death benefit. And there are some other death benefits available as well, but I just like to include this on the list because it doesn't get included anywhere else. And somebody is asking about electing a second beneficiary. Yes, you can elect multiple beneficiaries. Let me get to that later when I talk about um, uh, designating beneficiaries for death benefits. So I'll save that question for a little bit later. Okay, let me tell you about your tier. You're all in one of these tiers. And the your tier that you are in is based on your date of entry into Acera, your first day of Acera membership, and when it was. Okay, so first off, let me help you figure out which one of these timelines to look at. If you are a safety member, you're looking at the bottom timeline. Safety members are sheriff's deputies and probation officers. And there could be some other sworn officers that I'm not aware of that are considered safety members. So you're looking at the bottom timeline. Now, everyone who is not a safety member is a general member. Okay, so you're either safety or general. General members, you're going to look at the top timeline unless you're a general member who works for the housing authority or a general member who works for Livermore Area Recreation and Park District, and then you look at the timeline for your employer. Okay, now the way this works is if you enter the tier before the cutoff, if you enter Sarah before the cutoff date for the tier, that puts you in the earlier tier. So if you had entered a Sarah as a general member before July 1st, 1983, it was a long time ago, that would have put you in tier one. There's not a lot of tier one members left who haven't retired yet. Now, if you entered a Sarah July 1st, 1983, all the way up to December 31st, 2012, that would have put you in tier two as a general member. If you entered a Sarah January 1st, 2013 and beyond, that puts you in tier four. And that is the case with all four of the timelines. Now you'll note that the housing authority has a different tier one cutoff. LERPD doesn't have a tier two; they have a tier three, and there's a different cutoff for that. Safety members, there's three different tier twos. And if you entered a Sarah between October 17th, 2010 and December 31st, 2012, you had the choice of tier 2C or tier 2D. And if you didn't make a choice, you were defaulted into one of them. For everyone, if you don't know what tier you're in or you don't remember your date of a Sarah entry or both, the easiest way to figure out either one of those data points is to log into your account on our website. Okay. Let me show you how to do that real fast. So here is our website, acera.org. So you just type in acera.org to get here. On every page, there's a login button. So you're just going to click the login button. And then if you have already created a login here between October 2024 and now, all you need to do is enter your username and password to log in. If you forgot either one of those, there's options for that here. If you have not enrolled in this yet, you're going to need to click the enroll button. If you logged into your account before October of 2024 and haven't logged in since then, you're going to need to enroll because we launched a new member portal when we upgraded our pension administration software, and we deleted all the old logins so that in order for you to make a new login to increase security. Okay, so you're going to need to enroll. And let me just take one more aside here. If you're brand new and you started your job within the last 7 weeks, you cannot enroll in the member portal yet. Okay, so what you need to do is wait until about 7 weeks after you start your Acera covered position, you'll receive a letter in the mail from us. It's called a welcome letter, and it has instructions on how to enroll in this, and also how to fill out our Acera welcome form. So you need to wait for the letter. You can't enroll before that when you receive the letter because you're not in the system yet. Okay, so for everyone else who needs to enroll, you click the enroll button and you're going to fill out the form. But to fill out the form, you're going to need this enrollment pin. So you have to click request an enrollment pin, fill out your info, hit request pin, and what this does is it generates a paper letter in our office. We're going to put that in the mail for you that day. So you'll receive it probably 3 or 4 or 5 days later through US mail. And then once you get that pin, it will have instructions on how to return to this page, put in your pin, and and finish your enrollment. Put all your info and click enroll. And then once you get in there, you can see your Acera tier and your Acera date of entry and a lot of other stuff, including getting the precision benefit estimate, which I'm going to show you later. So I'll have screenshots of that later. Um, so it does take, if you've never done it, it does take a few days to log in because you got to wait for that PIN, but that's just because we want to have extra security on the account. Somebody's asking what's the difference between the tiers. The way that we calculate the retirement formula that determines your pension has a little bit of different rules between the tiers, and that will become obvious when I show you the Acera retirement formula. Okay, so hang on to that question, and you'll see that in a few slides when we talk about the Acera retirement formula. Now, what are you looking at right now? This is not the Acera retirement formula. This is not the formula that we use to determine your pension. This is kind of the crux of this whole presentation, okay? So what I want to do in this presentation is get you on a trajectory to have adequate retirement income by the time that you retire, okay? And so this is a simple way to illustrate that is with this addition equation, okay? And this kind of represents if we take a little peek into the future, okay? So peek far into the future when it's time for you to retire. Once you stop working and you retire, you're not going to have income from your employer anymore. So you're going to need income to pay for your life in retirement. Where is that income going to come from? Well, this equation kind of represents the three sources of potential retirement income that you will have once you retire. Okay. So first off, you have your Acera pension. You could also think about your Acera pension as a paycheck for life, kind of like the title of this webinar, Paycheck for Life, because you're receiving your paycheck from your employer throughout your career, but you're also earning credit toward retirement with Acera. And once you retire and start collecting that Acera pension, it's kind of like a continuation of the paycheck that you were receiving from your employer, except now it comes from Acera based on the credit that you earned with Acera while you were working. So you're going to get that every month for the rest of your life. So that's the first source of your retirement income is your Acera pension. And if you belong to other pensions from previous work, you can kind of lump those into this category of pensions, guaranteed income for life. Okay, Social Security is also guaranteed income for life, but it's kind of a separate category. It comes from the federal government. You earn credit in the Social Security system throughout your career, you pay into the federal Social Security system and you can collect it starting at age 62. If you wait a little bit to start collect it, your payment goes up, and I'll talk about that later. Okay. But that's the second source of income. Anything beyond your pensions and Social Security is going to be your personal savings and investments. Okay. So maybe you don't save additional money currently for retirement. Maybe you don't have any investments. Maybe the thought of how much your pension is going to be, how much your Social Security is going to be, how much do you need to save, where do you need to invest? Maybe that's super stressful. That definitely the idea of those things, if you just throw those words out there, throw those ideas out there, it seems stressful to me, okay? So I get it. But what I'm going to walk you through at the end of the presentation is we're going to use some technology. We're going to pull out some calculators. We're going to get a Sarah precision estimate. We're going to use the Social Security calculator. I'll show you, basically how to do that. And then we're going to use a different calculator to determine if you're on a trajectory based on your Acera pension and Social Security alone, that's going to adequately replace your working income with retirement income. Financial planners will tell you that you're going to need to replace at least 80% of your working income with retirement income from one or two or three of these categories combined. Needs to get you to at least 80% income replacement. And so the technology that we're going to use, which is extremely simple, like you'll get it right off the bat. So I think it will remove all the stress from this whole situation. Is that the calculator will show you if you're currently saving enough, or if the Acera pension and Social Security combined gets you to 80% income replacement, and if not, how much you might need to save additionally. And then we'll talk about where to save that. And so it's actually going to be pretty easy. So we're going to return to this idea, but I like to provide context. So this is kind of the overarching context of this conversation. What I'm going to do now is tell you how we calculate your Acera pension because there are a few levers that will help you dial in your Acera pension. If you understand how we calculate it, it will help you dial that in. Most of the way that you're going to be dialing in your retirement is through the levers of savings, like how much to save and where to save. Okay. So that's going to be most of your leverage, but there are a few levers you can pull with the Acera pension. So I'll walk you through that. Okay. So that's what we're going to talk about, the Acera pension. Then we'll revisit this slide and finish out the making a retirement planning picture. Let me check the questions real fast. Okay, somebody's saying my voice is cutting out. Is that happening for anyone else? Okay, getting some no's. Okay. Okay, great. So yeah, the person who says it's cutting out, you may just need to sign out and get back in, or there may be a okay, great, that's fixed. Thanks for letting me know. I appreciate it. Somebody says it's echoey. That's not good. Is anyone still getting echoes? I'm not sure there's anything I can do about that. Okay, some people are saying no echoes. Sounds good. Okay, no more echoes. Okay, good. It seems like that might just be an anomaly. So you may want to try signing out and signing back in if you're hearing an echo. Okay, great. So let's see here. What were the questions? Is the general tier including management and executive positions? Well, management and executive positions for who are sworn officers who work for the sheriff's department and the probation department, they would be safety members. Executives and management who work not as in the sheriff's department or the probation office, who are not sworn officers, would be general members. So being a manager does not determine whether you're general or safety one way or the other. Somebody's asking about the Sarah pension check and the Social Security check and whether you can get 100% income replacement from those, I guess is the question. You could if you worked long enough. If you worked 35 or 40 years between the Acera pension and the Social Security, you could probably get to 100% income replacement. I'll show you a calculator later that will help you determine what percentage income you're gonna be replacing, and I think it will illuminate it for you. Okay, so since we're gonna talk about how the Acera pension is calculated and how to dial that in, let me show you how we calculate it. This is the retirement formula that we use when you go to retire. So this is what we calculate for you based on these three data points from your career. These are the three factors in the retirement formula. These are the three categories that you are earning credit toward retirement in with Acera, because these are the three things we multiply together to get your monthly retirement allowance for life when you go to retire. Now, you may be asking, since you are either new or you're in the middle of your career and your retirement is a long way away, um, why are you showing this to me right now? Well, if you understand how this works, it will help you dial in each one of these three factors because these are the three kind of levers. If you watch each three of these numbers, you can kind of figure out what the monthly retirement allowance is going to be that comes out of us doing the calculation in the future. So it's good to know these things going in because there are some things you can do, like working longer or purchasing service credit, or there's a few ways that you can increase your salary in the formula as well. Okay, so let me show you how we do the calculation. So when you go to retire, far into the future, when it's time for you to retire from Acera, you are going to get as your monthly retirement allowance for the rest of your life, that you're going to get paid each and every month for the rest of your life, you are going to get a percentage of your highest salary for each year of service that you work. Okay. This sentence is saying in English what this multiplication is doing. I think it will help illuminate it a lot easier if I plug in some numbers here and do an example. Okay. So let's say, for example, that the percentage of your highest salary that you are going to get for each year of service is 2%. And let's say, since service credit is measured in years, let's say that you work for exactly 20 years when you retire in this example. Okay. So what that means is that you are going to get 2% of your highest salary for each one of those 20 years of service. We're basically taking 2% plus 2% plus 2% plus 2% 20 times. We're essentially multiplying 2% times 20, which is 40%. So that means your retirement allowance is going to be 40% of your highest average monthly salary when you are working. So this is your working average, your highest average working salary. Now, to finish out the example, let's say that your highest average monthly salary before you retire is $5,000 per month. So now we know, based on the percentage that you're getting for each year of service, and that that equals 40%, your monthly retirement allowance for life is going to be 40% of your highest average salary, which in this case would be $2,000 to finish out the multiplication. Because 40% of $5,000 is $2,000, or 40% times the 5,000 is 2,000. Okay. So you can see it's not super complicated. That's basically how it works. The bottom line there, if you don't remember anything else about this, is that because this is a multiplication, the higher any of these three numbers are that get multiplied together, the higher the retirement allowance is going to be. So the higher the age factor percentage, the higher the years of service credit, the higher the salary equals a higher monthly retirement allowance for life. Okay. Now the age factor percentage is going to go up the older you retire, and the service credit is going to keep going up the more and more you work. So kind of the way to dial these two in is just to work longer. So you get age factor percentages get older, service credit is work longer. Those kind of go hand in hand. So you earn more and more of those together. For the salary, the way that you dial that in is by knowing that your salary is going to be one of the multipliers in the formula. So if you ever have opportunities to increase your salary, of course, even without knowing this, you would probably jump on that anyway. But the ways that you might increase your salary are through cost of living adjustments throughout your career, raises you might get, maybe promotions, or maybe you look for a higher paying position. When one comes open, you apply for it and you get that higher paying position. A different way to do it might be to leave your agency altogether if you find a higher paying position for a reciprocal agency. And I'll talk about that when I talk about career planning as reciprocity. So that would be a way to dial in the highest average monthly salary. So let me talk about how we calculate each one of these in a little more detail, and I think that will help answer some of the questions that are popping up in your head. Okay, so first, how do we calculate the age factor percentage? What, what percentage of your highest salary will you get for each year of service? Because it's not necessarily going to be 2%. That was just an example. It's going to be based on your age at retirement. And we have this age factor chart. This is a sample of some of the age factor percentages that correspond to the ages. And each tier has its own set of these age factor percentages. Okay, so you're only going to look at the column for your tier. If you're a general tier 4 member, you're only looking at this one column. If you're a safety tier 2B, you're only looking at this column. Okay, so you forget about all the other columns, they don't apply to you. Now, these are the percentages that come from state law. So these percentages don't change. Okay, what does change is your age. Sorry, as you move up in age along, you move up in this age factor percentage chart. Okay, so as you age, you get higher and higher age factor percentages. So you'll note they get larger and larger at higher and higher ages. And the way this works is, for example, let's say that you retired as a general tier 4 member at age 60, well, that shows that you would get a 1.80% age factor percentage because you're in tier 4, you're retiring at age 60. 1.80% is the percent of your highest salary that you would get for each year of service. So again, it keeps going up and up the older you are when you retire, up to a maximum age factor percentage for your tier, which is what each one of the blue boxes means. If you retire at that age or older, you get the highest age factor percentage for your tier. So if you retired at age 67 as a general tier 4 member, or 68 or 69 or 70, you would still get the 2.50%. So the percentages stop increasing at the maximum age for your tier. Now you'll note that I skipped a bunch of the ages, and that's just to give you a few examples. There's actually an incremental increase with every quarter year you age based on your birth date. You can read more about that at acera.org/age, and you can see a full chart of all the incremental increases. Okay. But that's basically how the age factor percentage is determined. Is it is based on your tier. These percentages are written in the law, and it's what however old you are when you retire, we take that percentage that comes from the law based on your tier and plug it into the formula with the other two factors. Okay. If you don't want to remember any of that, totally fine. I get it. Your retirement isn't for a long time. Just remember, if you take away one thing from that discussion, is that the older you are when you retire equals a higher age factor percentage up to the maximum for your tier. Okay, so the older, well, let me just move ahead. Okay, so that's how the age factor percentage works, and that's how we calculate it. Now, for service credit, how do we calculate that? Well, going back to the pension milestone chart, you start earning service credit when you enter Acera. So on your first day of Acera membership, you start earning service credit. Service credit is measured in years. You're going to earn service credit all the way up until your termination date from your job. And in fact, we not only calculate it in years, we calculate it down to the fraction of a day. So every 15 minutes you work, you earn 15 minutes of service credit toward retirement. And if you look at your service credit number by logging into your account on our website and going into our member portal, you'll see that your service credit number will say something like, if you've been here 7+ years, it'll be like 7.842652. All those decimal places are us calculating your service credit down to the fraction of a day, and you get all the decimal places in the retirement calculation when you finally go to retire. So you earn service credit right up to the last 15 minutes on your last day of work. Now, you earn service credit during your regular work hours. You also earn service credit during your earned leave times, including vacation leave, sick leave, management leave if you get that, comp time if you have some of that, regular holidays, and floating holidays. When you mark those on your timesheet, you earn service credit for that time. It does not count against you for earning retirement credit with Acera. Now, you do not earn service credit anytime you're on leave without pay and you're not getting a paycheck from your employer, you're not earning service credit. If you purchase additional vacation, which is something that some of our employers allow, which is that you have your earned vacation and maybe it's not enough, so you purchase an extra week of vacation. When you mark a purchased vacation on your timesheet, you do not earn service credit during that time. Okay, sold vacation. This is a different concept. This is where you take your earned vacation and you sell it back to your employer for cash. So you don't go out on a vacation. You're in the office. You sell or you're at your work site. You sell your vacation back to your employer for extra cash. You do not get service credit for that. You also do not get service credit for overtime, on-call time, or standby time. Okay. And then somebody let me just take a side let me just take an aside here to answer this question that's been up on the board for a minute. The question is, you're trying to understand if management positions are pensionable. You are earning a pension with Acera in a management position if you are a member of Acera and you're earning credit toward Acera retirement. If you're in my guess is that I can't, if you're working for Alameda Health System, okay, there may be some positions that are not considered retirement eligible with Acera, because that's something that's unique to that employer. If you're working for our other five employers, and you're working full time as a manager, my guess is that you're absolutely an Acera member and you're paying into Acera and you're earning credit toward retirement with Acera. The way to verify your membership with Acera, there's a few different ways you can do it. One is to look at your pay stub and look at the before tax deductions line and see if there's money being taken out for retirement and sent to Acera. If that's happening, then you're definitely an Acera member. Another thing to do would be to ask your human resources department, or your payroll clerk. They usually know, especially if you're in Alameda Health System. Some of the positions are retirement eligible and some of them are not. Um, but it doesn't really have anything to do with management or not. Okay, and let me address this question real fast, and I'm going to save the salary questions. I'm going to get to the back to those in a minute. Um, Somebody said that because I mentioned on-call time and standby time. Okay, so what happened is that, and there's a pop-up when you log into your account on our website that's mentioning that we're evaluating some of that. They're not, so you don't earn service credit for the on-call time or standby time. You may earn salary credit in the salary column of your um, of the retirement formula. So remember the time you may earn standby pay and on-call pay may count toward the Acera average highest average monthly salary, but it doesn't count toward service credit. Okay. Now, a lot of times it does not count toward the salary because in order for it to count, the law says that everyone in your job classification has to it has to be mandatory, and everyone in your job classification has to be administered that time equally. And what we found in some internal audits that we've done is that the employers were marking that amount of salary as so that it should be included in that when those two things were not the case. So what we're doing is we're currently evaluating it. If you have been receiving standby pay and it does not count to your Acera toward your Acera pension, but it was being counted because your employer marked it wrong, you will receive a refund of contributions for the contributions that we took out for part of that. But we're still evaluating that. You're going to get a letter in the mail if that's the case. So you can stay tuned and look for the letter in the mail. And if your standby pay does count and it will be included in the salary calculation, then you won't receive the letter. Okay. And then we'll remove that from our site once we're done evaluating that. Okay. And yeah, it sounds like you are working for Alameda Health System. Um, the person with the question about the management position. So usually we can't answer that. It's your employer that has to answer that because Alameda Health System, we're we're not super clear on which ones are designated as retirement eligible. They're the ones that do the designating on that. Okay, so back to our discussion on service credit. I mentioned that the more service credit you earn, the higher your pension is going to be because service credit is one of the three multipliers in the retirement formula. One way that you can dial in extra service credit to increase the amount of service credit in the formula that we're going to calculate, which increases your pension, is by purchasing eligible time. If you have eligible time, not everyone has eligible time to purchase. And you can't just purchase extra time because you want to. It has to fall into one of these categories, okay? And the theme of these categories is that you you incurred a type of time or did a type of work that the law did not allow for you to earn service credit during that time, but it does allow for you to go back and purchase that time later. So let me walk you through the categories. The first is labeled ineligible non-covered service purchase. This is if you started out working for your Acera employer, one of our six employers, part-time. Um, to enter Acera, you have to be in a full-time retirement eligible position. So if you started out working part-time, you weren't an Acera member yet. Now, I'm not talking about working for a temp agency, an employment agency, or under contract. That time is not purchasable. If this was just plain old part-time work, once you achieve Acera membership, that's purchasable. TAP time, TAP is the county's temporary assignment pool. All time worked in TAP, in the TAP program is purchasable. Other ways that they may label time worked before achieving a SARE membership, they may label it seasonal, intermittent, service as needed, project, or per diem. All of those are purchasable. So if you incurred any of that type of time before your SARE membership with your employer, you can go back and purchase that. Okay, now the next category is the 2 weeks between your hire date and your entry date. That's purchasable. Next category is unpaid medical leave. If during your career you ever go out on unpaid medical leave, so often what happens is you'll go out on medical leave and you'll burn through all your leave, your earned leave, and then you still have a job, but you're just on unpaid medical leave. When you return from that leave, you can buy that leave time up to 1 year per instance as service credit. Um, some people ask about FMLA. FMLA is the Family Medical Leave Act. That's a federal law that says that you can be out on medical leave for 12 weeks, and there may be some extensions to that without losing your job. So that just guarantees you a job. And sometimes what they'll do is when you're out on medical leave, they'll designate it as FMLA. But if you're using your leave balances, you're already earning service credit for that part of it. So that's you don't have to worry about purchasing that. It's just when you run out of those and you're out on unpaid medical leave, when you return from that unpaid medical leave, you would want to look at purchasing that time. State disability insurance leave. This is where you get injured or you're just out on you're temporarily disabled or you're out on workers' comp and you're being paid from the state disability insurance or workers' comp system. Sometimes what happens is you're paid a partial paycheck from your employer and you're paid partially from the state system. For the partial paycheck from your employer, you already earn service credit for that. For the part that you're being paid from the state system, you're not earning service credit for that time, so you could buy that time when you return from that leave. Military leave during membership. This is not prior military service to obtaining your job. This is where you're actively working for one of our employers. And usually what happens is that you're a reservist and you get called up to active duty. So you go out on military leave, you serve your active duty, and then when you return from the active duty, you pick back up on your job and start working your job again. And that time out, that is military leave during membership, and you can buy all that time when you return. Redeposits of prior memberships. This is where you used to be an Acera member in the past. You did some work for one of our employers. You earned credit toward retirement. You paid into the system, but you stopped working here. And when you did, you took a refund of your employee contribution account. And then you go do something else. Then you come back and you get another job here, and you want to get that original amount of service credit back from that prior membership. Well, you can redeposit an equivalent amount of money, and that is called a redeposit of a prior membership. Redeposits of community property. Okay, so California is a community property state, which means if you're earning a retirement with a Acera while you're married or in a state registered domestic partnership, when that partnership or marriage dissolves, there is community property to be divided among the ex-spouses and ex-partners. And Acera, the retirement that you earned with Acera, your account is part of that community property. So often what happens is part of your account will get divided and given to your ex-spouse. Now, it depends on how you negotiate it. That's not always the case. You might negotiate away other assets and keep your Acera account whole. But if your ex-spouse does take part of your account with them, what they take is a portion of your service credit and a kind of what's the word equal portion of your employee contribution account or corresponding portion of your money, basically, your employee contributions. So they get their own account. If they take a refund from their account, we will send you a letter in the mail letting you know that they did that, and then you have the opportunity to redeposit an equivalent amount of money back into Acera to get your um, service credit back that they took with them, and that's called a redeposit of community property. And then the final category is other California prior public service. This is where you used to work for another agency in California. There's some examples here. And you're not eligible for their pension from whatever system they use for their pension. Usually it's for one of two reasons. Either you didn't work there for long enough to earn enough credit to collect anything from their pension, or when you left there, you took a refund of your contributions from their system and canceled your account over there. Now, if you do that, you can buy that time as a Sarah service credit, and that's called buying other prior public service. So those are the only categories. Anything outside that category is not purchased. These categories is not purchasable. And let me give you some more information about purchasing service credit. Now, some of you, your brain might be fogging over because I just threw a lot of information out at you about this. Maybe none of these situations applies to you. You don't have any eligible time. But I like to orient everybody to these because maybe in the future you incur one of these types of time. Maybe you go out on unpaid medical leave. Maybe you go out on state disability insurance leave or military leave. Maybe you get divorced and you're looking at redepositing community property. Okay, so even if these don't apply to you now, it's good to know because it might happen in the future. And it's good and the best time to purchase the service credit is as soon as you can, and I'll explain why in just a minute. Before I do that, let me tell you about time that's not eligible for purchase. Vacation purchase time. You purchase extra vacation, you mark it on your timesheet, you go on the purchased vacation, you don't earn service credit, and it's not purchasable later. Non-medical leave without pay, not purchasable. Contract or temporary agency time, not purchasable. Other prior public service where you still have contributions on deposit with the other agency. So if you do have time with another agency and you want to buy that as a Sarah service credit, we won't let you buy it until you take a refund from that other agency. Now, having said that, if you have enough time over with that other pension where you will be able to collect a pension from them one day when you become eligible, maybe you have to reach a certain age. It might be, and in probably my guess, my wild guess about this would be that in most cases, it's probably better for you to leave it over there and collect their pension than try to take a refund and pay for service credit with a Sarah because these purchases are very expensive. Um, in contrast to this whole list. So that's one thing I want to say about that. The second thing I want to say about that is if you are somebody who has time with a different agency, you have credit with a different pension fund, and you have linked that pension fund together with a Sarah, you don't have to worry about purchasing the time because you're already getting the benefit of reciprocity, which I will talk about later. So don't worry about that. This does not apply to you. Okay, let me finish out my talk about service credit and then I'll get to the service credit questions. Okay, so let's say that you want to make a service credit purchase. How much does it cost? What it costs is whatever your employee contributions would have been had you worked the time. So, for example, let's say that you went out on unpaid medical leave 5 years ago for 3 months. You were out on unpaid medical leave for 3 months. Well, if you were working in your job during that 3 months, you would have been getting a paycheck from your employer. And you remember every paycheck you receive from your employer, Acera takes an employee contribution out of it. So whatever that dollar amount would have been had you been working that time, that we would have had to take out of your pay that you were getting paid at that time, that is what it's going to cost to make the service credit purchase. Plus interest. The interest accrues the longer you wait to purchase service credit, more and more interest is going to accrue because if you had been here working and you had received your paycheck so that Acera could take the money out of your paycheck to put into Acera's fund, we would have invested it and it would have earned interest. So, however much interest that money would have earned between the time that you're trying to buy and now, is the amount of interest that you're going to have to pay. So the longer you wait to purchase service credit, the more and more expensive it gets because the interest continues to accrue. So another way to say that is the best time to purchase service credit is as soon as you identify that you have one of these types of time to purchase, okay? So if you ever go out on unpaid medical leave, as soon as you return from unpaid medical leave, submit our purchase request form. The same goes for all of these types of time. As soon as you incur it, submit our purchase request form. And that's how you figure out exactly how much it's going to cost. So that's how you get the process rolling. You go to acera.org/forms, find the purchase request form, fill it out, submit it to us. We're going to do some calculations. We're going to send you a letter in the mail and tell you how much it's going to cost to make the service credit purchase. At that point, you can decide if you want to make it. So just because you fill out the form, you're not obligated to make the service credit purchase. So we're going to tell you how much it's going to cost. And at that point, when you get the letter, that's when you can decide to make it or not. And you can even purchase just part of it if you want to, except for the redeposits. Those are all or none. Okay. And you have different payment options at that point, and we'll outline those for you in the letter that you get. You can write us a lump sum check. You can roll over pre-tax funds from a different retirement account if you have some. We'll split it up for you through payroll deductions and take it out of your paycheck over time, the easy payment plan. So we'll do any combination of those that you want. Okay, so you have a lot of options to make the service credit purchase. Okay, so let me check the questions here. And I'm gonna save the salary questions and get to those in just a minute. Okay, so somebody's asking, what's the difference to earn service credit if you work 75 hours biweekly or 80 hours biweekly? Nothing. There's no difference. If your position is considered full time at 75 hours biweekly, which is 37 and a half hours weekly, that's full time for you. So if you work for 1 week, you earn 1 week of service credit. So that's how that works. Somebody's asking, do we have to buy back the first 2 weeks? If you work for Livermore Area Recreation and Park District or the Housing Authority, you already earned service credit for the 2 weeks. You don't have to worry about it. For the other four employers, it's your choice whether you want to buy back the 2 weeks or not. We don't force you to buy back any. We don't force you to make any service credit purchases. Okay, so somebody's asking, I've been with the county 15 years. I previously worked for a state agency under contract for 3 years and did not have a pension with them. Can I buy the time? That is going to be a question for my colleagues. So if you go to acera.org/contact on the web, or you call 510-628-3000. Again, that's 510-628-3000. I would definitely ask my colleagues on that because I don't know the answer to that. My guess is if it's under contract, probably not. Because you usually can't buy the work under contract, whether it's if it's for another agency, there may be different rules, but my guess is probably not, but definitely ask my colleagues. Okay, next question. If you worked for East Bay Recreation and Park District part-time, can you do a service credit purchase? Maybe. That would be definitely worth inquiring. So you can do the same. You can, and I'll type it in. You can ask that question of my colleagues, acera.org/contact, or call 510-628 3000 if you want an instantaneous answer. The other way to do it would be to fill out the purchase request form, and when it asks you who the employer was, you put in that employer, and then we'll let you know whenever we send you the letter whether it's purchasable or not. There is a waiting period on this because we do get a lot of these requests, so it may take some weeks or perhaps months to hear back from us on get the letter for with the cost. So just expect to have a little bit of a wait on that. Okay, so moving right along. That's how we calculate the H factor percentage, the service credit, the highest average monthly salary. How do we calculate that? Well, when you go to retire, our software is going to find In your payroll records, because we have all of them in our database, it's going to find your period of highest pay in your entire career, your period of highest consecutive pay. In our pension lingo, this is known as your final compensation period. So that's what we call it. It's your period of highest pay. If you are in tiers 1 or 3, your final compensation period will consist of your highest consecutive 26 biweekly or 12 monthly pay periods. If you are in tiers 2 and 4, which I suspect most everyone is, your final compensation period is your highest consecutive 78 biweekly or 36 monthly pay periods. Essentially, if you're in tiers 1 and 3, it's your highest year of pay. If you're in tiers 2 and 4, essentially or approximately, it is your highest 3 years of pay that we're looking at. And again, it's consecutive pay periods, okay? So since our goal for the calculation is to get an average monthly salary, so your highest average monthly salary, the software first finds your highest pay periods from anywhere in your career. Now, for the vast majority of people, it will be at the end of your career because most people get your highest rate of pay at the end of your career, but not everyone. So I think somebody was asking about that. If your salary changed to a lower amount when you're ready to retire, your final compensation period may be earlier in your career because our software will find your highest pay periods from earlier in your career. So yes, your pension would be based on that earlier period. Okay. And what it does, what our software will do is look at your total pay over those highest pay periods and take an average. So it will take the total pay, divide by 12 months for tiers 1 and 3 to get the average, divide by 36 months to get the average for tiers 2 and 4. So it's a pretty basic calculation. Okay. So that's how we determine your highest average monthly salary. Now, there is a question of what pay goes into this determination. First of all, somebody asked about this. It's your gross pay before any deductions are taken out. Okay. And somebody asked how long. We just answered that question. In most cases, so if you're in tiers, again, tiers 2 and 4, highest 3 years, tiers 1 and 3, highest year. Okay. So the types of pay that are included in the calculation are base pay. This is going to make up the bulk of everyone's highest average salary in their highest average salary calculation. Now, there may be some other types of pay included. Sometimes these are known as footnotes. Okay, that's sometimes what they're called, but they're other pay codes. There's like 1,000 different pay codes among our 6 employers. So I can't tell you off the top of my head whether your particular pay code counts in the calculation or not. If it does count, it does increase your total pay during that time and it will make your pension higher. So if you want to know whether it counts or not, go to acera.org/paycodes, open up the PDF for your employer and find your pay code in the list, and it'll say yes or no, whether it is included in the salary calculation or not. The one pay code that I do know that never counts is overtime. That never counts. Now, there's 2 more types of pay that may be included as salary for calculating your retirement. And this is only for tiers 1 and 2 members, not tiers 3 and 4. If you are compensated for your earned vacation during that final compensation period, either through selling your vacation back to your employer while you're still employed, or simply having it left over in the books when you stop working, at which point they'll cash it out for you. That could boost your salary a little bit. Now, I'm not going to take a deep dive into that concept in this webinar because that's a ways away. But if you are in tiers 1 or 2 and you do want an explanation of that, the best way to do that might be to go to our website, acera.org, scroll down to webinars and seminars. And here we have the pre-retirement webinar. I do talk about this for probably 20 minutes. So just pop that open. It's a YouTube video. Hit play, fast forward until you get to basic to a Sarah. Hang on, let me retro pay before you retire. Like turn off the volume here. So fast forward until you get to that slide, and then there's like a 20-minute discussion of that concept. Again, pre-retirement webinar on the homepage. Okay, so that's the type of pay that will be included in your salary. Somebody's asking, how does selling PTO impact your pension calculation? That's exactly what I was talking about. So if you're in tiers one and two, selling PTO, which I assume you work for Alameda Health System since you're calling it PTO, could boost your salary. So definitely go check out that discussion in the pre-retirement webinar if you want to know more about that at this point. Another place to look to get information about that, if you go to acera.org/vacation, there is some information on the website about that. Okay, so one more thing I want to say about salary is the limit for the tier four members on how much salary Acera is allowed to include in your salary calculation. This is a new rule, and I say new, it goes back to 2013 when the legislature instituted what they called the Public Employees Pension Reform Act, which created Tier 4. It took effect on January 1st, 2013. And one of the new rules was that the total salary that we're allowed to consider for your pension is capped on an annual basis. General members, the current cap for 2026 is 159,733. For safety members, it's 191,679. These numbers are the exact same numbers as the Social Security wage index limit, which is also the cap on, when they take money out of Social Security, at what point they stop taking money out of Social Security for your check. Those limits can always be found at acera.org /limits. So they do go up each year when those Social Security wage index limits go up. But what it means is that if you have a higher salary than this, Acera cannot include any more annual dollars in your highest average salary calculation when we calculate your retirement. So that's what it means for your retirement calculation. What it means for your um, employee retirement contributions during the year is that at the point in the year, let's say that you had a $200,000 salary as a general member. At the point in the year where you are paid out 159,733, maybe it's like in October. For the rest of the year, we will stop taking out employee retirement contributions from your retirement check until January 1st rolls over, and then we'll start taking contributions again. So that does leave you a little more money in your paycheck to save in, one of your retirement accounts. And if you time it right, you could save that extra money in your 457B account. They do, and we'll talk about 457B accounts in the second half of the presentation, but they do. There's like maybe like a two pay period run up to changes, so you would want to plan two pay periods in advance, but you would fill out the um, 457B change form to increase your contributions to the 457B account for the rest of the year. And then you could change it back maybe like December 1st. You submit the form again to change it back as of January 1st. And somebody's asking what's safety. Safety members are sheriff's deputies and probation officers and any other sworn officers. General members is everyone else. So if you're not a safety member, you're a general member. Okay, and here's the whole thing put together. So this is an example of our full retirement allowance formula calculation for when somebody goes to retire. This person is a tier 4 member who is a general member. They retire at age 65 after having earned 25 years of service credit. So because they're age 65 and they're a general tier 4 member, when we look at the age factor percentage chart, we know that their age factor percentage should be 2.30%. So we take that out of the chart, we plug it into the formula. Their years of service credit is exactly 25 years, so 25.0000. But if they had earned, 25 and a quarter, it would be 25.25. And then their highest average salary in this example is $6,000. So we multiply all that out. That gives us their monthly retirement allowance of $3,450. It's pretty simple. One extra thing that I want to point out here is you can always take the age factor percentage and the years of service and multiply them together, and that shows you what percent of the salary your retirement allowance is. Another way to say it is it shows you the percentage of your working salary that you're replacing with your Acera pension income. In this case, it's 57.5% salary replacement. So that means that their monthly retirement allowance of $3,450 is 57.5% of $6,000. Why is this important? Because when we get to the retirement planning picture discussion, um, just as a reminder, we're going to be targeting at least 80% income replacement through a combination of your Sarah pension, Social Security, and savings. If you did get up to 57.5% salary replacement from the Acera pension alone, you would be doing pretty darn good. So you would definitely be able to, adding in the Social Security, I think in most cases, be able to hit the 80% just through those two things. Okay. And somebody says, can I see the cap once more? Absolutely. Here are the caps. And if you want to see what the caps are, they're always posted out on our website at acera.org/limits. Okay, let me show you how to get a precision pension estimate from Acera, and then we might take a break after that, or maybe after, there might be one more short topic. This one's pretty short. Okay, so what I told you up to now is all of the details about how we calculate your pension. And if you remember, kind of the bottom line in order to dial your pension in for Acera is you just kind of work longer to increase the age factor percentage and the years of service credit, or you look for ways to increase your salary to increase the salary part of the equation. Or additionally, to increase your service credit, you can um, purchase service credit if you have eligible time. So that's kind of all the ways. You don't have a lot of levers to dial in your Acera pension besides working longer, but there are some little ways here and there. And somebody's asking, do those caps, those tier four caps ever increase? They increase every year whenever the Social Security wage index limit goes up. And we always have those consistently posted at acera.org/limits. Somebody's asking to go back to the last slide, this one. Somebody's asking, why are there caps? I think this California state legislature back in 2012, when they passed this law, they thought there was this idea that pensions were paying out a little too much or something, and they were like, I guess the idea was that they were too much of a burden on taxpayers or something. So they decided to cap them, you know, in order to take the burden off, the perceived burden off taxpayers. It's really a perceived burden because it depends on how you look at it. I mean, most your employee contribution is your deferred pay, so you're paying into the pension, and then the employer contribution is like your benefit package. Instead of paying into a 401k, they're paying into a SERA for you. Um, so I think it was mostly a perception issue, and it kind of fixed the perception issue because we haven't heard, a lot of people uh, trying to mess with pensions after that. So I think that was the thinking there. The police get higher caps. The safety members get higher caps. The sheriff's deputies because they do not pay into Social Security. So all the safety members, bargaining units have chosen not to pay into Social Security. I think they made that choice. I think it was their choice. So they have a higher pension percentage. So they make much higher contributions into Acera than general members do, and then they have a higher formula, so they get more from Acera just to make up for not paying into Social Security, not participating in that system, and it all kind of makes up for itself. They pay more in, we invest that higher amount in, more interest is paid on their investments and so on and so forth. So it all kind of evens out. Okay, so how to get a precision pension estimate. So if you don't want to hold any of that Acera calculation information in your mind, you don't have to. All you need to do is use our benefit estimator, and it's super easy. So I showed you earlier how to enroll in the um, the member portal that we call Member Direct. So I won't walk through that again, but basically you just click the login button and it will take you to the login page and you click enroll. Okay, if you haven't done it yet. Once you get in there, we have this tool called estimate a benefit. Okay. And what it's going to ask you for is a plausible retirement scenario that you want a benefit estimated for. So you think about when you might want to retire. Maybe you want to retire at age 60, at age 62, at age 65, at age 70, at age 55, at age 50, at age 52. You can run scenarios for all of these different ages. So you can run as many of these estimates as you want. So just keep using it. Do one for every different age or every half year age. Like, use this as much as you want. So just start off with just think of one, maybe retiring at age 62, since that's when you can first collect Social Security, and you plug in a set of dates that match that scenario. So the separation date is the last day on payroll. Payments begin date is first day of retirement. And the reason we separate those out is because a lot of people will go straight into retirement, but not everyone will. If you know that you're going to quit maybe in 5 years and not retire immediately, you could have a much later retirement date, and you can do that scenario here. Okay. So you plug in your dates. I'm going to zoom in so you can see it a little bit better. And then it'll ask you to put in beneficiary info. You can do that if you want. If you've already designated your beneficiary for your Acera death benefits, should you die as an active member, you might see this pre-populated. So you could just leave that information alone, or you can change it. If it is pre-populated, definitely double check the date of birth, and if it's wrong, correct it. And then there's some additional options here. If you leave these all unchecked, you get a nice conservative estimate, and then you hit generate, and you end up with an Acera retirement benefit estimate PDF. So the first page gives you your monthly estimated benefit, and and I think I have a zoom in on it. Yeah, here we go. So this is the first page. This is the table in the first page, and it gives you an estimate for different retirement options that you will have the ability to select at the time of retirement. My recommendation is if you don't want to, you don't need to understand what these different options do. They basically give you different combinations. It allows you to leave more to a beneficiary and less to you, basically. Most people pick the unmodified option, which leaves the most to you and still has a continuing payment to your beneficiary after your death if they qualify. So I would just kind of navigate on your retirement planning using the unmodified option. And then when you get closer to retirement, you might want to explore what the different options 1 through 4 do. Um, or if you're curious now, we have all that information out on our website. Page 2 of the retirement estimate shows you the data that it uses to make the calculation. And pages 3 and 4, I don't have screenshots of that, show you all the pay periods that it's using to estimate the average monthly salary for the purposes of this estimate. So, like I said, you can make as many of these as you want, and you can save them to your device. They all get saved in your member portal. If you don't want to save them to your device, you can just save them to the member portal. And that's a pretty easy way to get a precision pension benefit estimate. I didn't have that many screenshots because it's actually not that complicated. And you can once you get used to it, you can crank these out in 2 minutes. Let's see here. Um, Somebody's asking about beneficiary qualifications. I'll save that for when I talk about death benefits and designating your beneficiary. Somebody's asking about, is there a month that's better for retirement? Really, if you're when you're choosing your retirement date, and we do have a whole section of our website on choosing your retirement date. If you're getting close to retirement, there's this page choosing your retirement date, and there's various things that you're going to want to think about. Timing is kind of, I mean, there's kind of a timing thing where you don't want to retire right before one of those one of those quarter year age factor increases because you might miss out on an increase to your retirement allowance. So it talks about that. Um, there's also the idea of retiring in March or as of April 1st. And that's just because our cost of living adjustment is posted for people who are retired as of April 1st. So if you retire in on April 2nd or for the rest of April or maybe even through the end of May, you do lose out on some money that you would have gotten had you, in a lot of cases, had you retired in March. So if you're going to retire in the spring, there's kind of timing around that. For the rest of the year, there's not really timing. You just work, until you achieve the retirement allowance amount that you're targeting, and then you go ahead and retire. And somebody's asking, are we taxed on our monthly retirement pay? Yes, you are, because your payments into Acera are made on a pre-tax basis. So the government is going to collect income taxes on disbursements coming out of the system. Okay, next, let me help you understand retirement eligibility. When can you retire? When are you first eligible to retire? You are eligible when you meet the combination of years of service credit and age that you need to become retirement eligible. So, again, this is the first date that you can retire, but you don't have to retire as soon as you're eligible. You can keep working and earning more and more credit toward retirement. So, I'll show you the eligibility combinations for tiers one, two, and three first, and then I'll show you tier four on the next slide. For tiers one through and two and three, you have three combinations. You have to be at least age 50. You have to have at least 5 years of service credit, and you have to have at least 10 years of membership. Now, everyone in those tiers already has at least 10 years of membership because those closed over 10 years ago. So forget about that number. Just think about you're at least age 50 and you have at least 5 years of service credit. Option two is that as a general member, you can have 30 years of service credit, or as a safety member, you can have 20 years of service credit and retire at any age, even if it's younger than age 50. Or option three is that you can have any amount of service credit and retire at age 70, even if it's less than the 5 years you need to retire at age 50. So if you stop working and you don't have yet 5 years, you can wait until age 70 and retire on the less than 5 years of service credit that you have. So that's tiers one, two, and three. Tier four, you have two combinations. As a general member, you can retire at age 52, or as a safety member, you can retire at age 50 with a minimum of 5 years of service credit. Or you can retire at age 70 with any amount of service credit, even if it's less than the 5 years you need under option number one. Okay, so those are the combinations. And once you're eligible to retire, you can go ahead and retire from Acera if you choose and start drawing a lifetime pension. Okay, so next topic, understanding additional benefits. I'm going to talk a little bit about the medical, dental, vision, other non-guaranteed benefits we offer. Disability retirement, that is a different type of retirement than what is sometimes called normal retirement or service retirement. Um, and that is if you ever become permanently disabled and you're no longer able to perform your job duties, you can apply for disability retirement if the disability is permanent. And that's kind of a separate track for retirement. If you're already eligible to retire under the service retirement, you can go ahead and do that while you're waiting for the disability retirement to go through because the disability retirement is a whole process. It can take like a year. And if the board awards you a disability retirement, then you have achieved the disability retirement. And there's certain benefits that come with that. There's more on our website at acera.org/disability. And then death benefits. So let me talk about the healthcare and the death benefits. Okay, first off, healthcare. The reason that I talk about these separately is because they're not guaranteed benefits. We've been talking about the guaranteed Acera pension up to now, but these are not guaranteed benefits. They're extra benefits that the county decided to start a reserve fund for back in the 80s. Acera administers the reserve fund. Our board of retirement does because we have a separate board than the county. And they're the ones that determine what the benefits are and what levels the subsidies reach and who gets to receive the subsidies. Their entire goal is to keep this fund sustainable. There's over $1.2 billion in that reserve fund currently. Um, And you can read more about it at acera.org/SRBR because it's called the Supplemental Retiree Benefits Reserve. But kind of the only thing that I want you to know about it is in terms of your retirement planning. And this chart that you're seeing, which is the years of Acera service credit to qualify. Because the board is trying to keep the fund sustainable and be able to continue offer healthcare into the future, healthcare subsidies into the future, they they set these rules, and their rule is that you have to have a certain amount of years of service credit to start qualifying for the healthcare benefits. The supplemental cost of living adjustment, which is an extra cost of living adjustment on top of the vested one. So you get two if your buying power erodes to a certain point. That doesn't Everyone gets that if their buying power erodes to a certain point. But the healthcare benefits, they start at 10 years. Okay. And the healthcare benefits are a medical subsidy. There's three levels of it. It's known as the monthly medical allowance, which is what MMA stands for. And there's a dental subsidy, vision subsidy, Medicare subsidy. Now, for dental, vision, and Medicare, it pays the whole premium currently. For the medical, it doesn't. It pays a portion of it, and you get more if you have more years of a service credit to qualify. So you'll note that they all start at 10, but then if you achieve 15 or 20 years of a service credit, then you get a higher medical subsidy. Um, and so the thing that I like to do is think about this in terms of retirement planning. If you have been working here for, let's say, 9.5 years, and you are considering leaving and going and doing something else, you might not want to do that until you reach the 10-year mark because between the first level of the medical subsidy, the dental and vision and Medicare subsidy, that's a lot of extra money. This is on top of your guaranteed retirement allowance that you would receive to pay for your life in retirement. You're going to need medical, dental, vision care anyway. So if you get over that 10-year mark, you can start getting the subsidies for that. So I like to come back to the pension milestone chart and kind of add in the 10-year healthcare subsidy minimum into here, just so that you kind of get it in your mind that 10 years might be something to shoot for in terms of Acera benefits if you can. And that's pretty much all I want to say about the healthcare benefits at this point. They kind of change periodically, different rules come in and out. None of that stuff happens very often. You can always read about it on our website. And somebody's asking, will the recording be available to us? Check back in about a week. Let's see, what's today, Wednesday? Check back by next Wednesday at acera.org/seminars or yeah, at acera.org/seminars, and the recording should be available then. Okay, so the next thing I want to talk about is the death benefits and designating your beneficiary or beneficiaries for them and keeping them current. Okay, let me define the term beneficiary. A beneficiary is somebody who gets a benefit. Your Acera beneficiary is the person that you designate to get your Acera death benefits. Okay, so what I'm going to do is show you a few slides about death benefits available to your beneficiaries should you die before retirement. Now, there are a separate but similar set of death benefits available to your beneficiaries if you retire and then die after retirement. So I don't talk about that here, that we talk about that in the pre-retirement webinar, but the benefits are pretty similar. Okay. Um, but these are the death benefits for your family planning purposes that are available to your beneficiaries should you die before retirement. Okay. So the first slide, if you're an active member and you are not yet vested, you don't yet have 5 years of service credit, and you were to die, and I'm not saying you die at work, you just currently have a job with one of our employers, and you're not vested. Your beneficiaries would receive a return of the balance of your employee contribution account, and that includes the interest that we post to your account every 6 months that we earn interest. They would also get 1 month of your salary for each year of service, up to 6 months worth of salary. So if you've already been working here for 4 years, for example, and you die, they would get 4 months of your salary in addition to the balance of your contribution account. Now, if you are vested, which means you have at least 5 years of service credit with Acera or combined among reciprocal agencies, your beneficiaries get a choice. They get that same option that I just told you. That's option number one. Option number two is a monthly survivor's allowance. And the monthly survivor's allowance is based on the idea that you retire as of the date of death, and they get a percentage of what your retirement allowance would have been. Option three is a hybrid of options one and two. So there's a lump sum and then there's a reduced survivor's allowance. Now you'll note that in this case, it says the survivor's allowance goes to a qualified beneficiary only. Now that is spouse, state registered domestic partner, Alameda County domestic partner, or minor children. Okay. Now, having said that, there is a way to expand the group of people that you can name as a beneficiary for a survivor's allowance, and that you can ensure that the maximum survivor's allowance goes to them, and that is called making the advanced death benefit election. Now, we try to make it super easy for you to make this advanced death benefit election. I'll show you how on the next slide, but what it does is it makes it so that any beneficiary can receive a lifetime monthly survivor's allowance, including children. If you don't make the selection, your minor children's survivor's allowance is not for the rest of their life. It will cut off at age 18 or can continue until age 22. If you do make the election and all it consists of is checking one box on one of our forms, you can leave them a lifetime allowance and it maximizes it. Okay. So I recommend just navigating by this slide as long as you go ahead and make that advanced death benefit election. Now, the way to do it is on our beneficiary designation form. Okay. Some of you may have already made this, some of you may have already not made this. We this is a brand new thing as of about 2 years ago. So we redesigned our beneficiary designation form at that point to include this checkbox. If you have redesignated your beneficiary in the last couple of years and you remember checking that box, then you've already made the advanced death benefit election. Or if you started work in the last couple of years, we've also included a checkbox on our Acera welcome form that you filled out, and you would have had the opportunity to check the box then. If you don't remember if you checked the box, you can contact my colleagues and they will tell you. 510-628-3000. There is nothing in the Acera portal that tells you whether or not you checked the box. We haven't fixed that we haven't upgraded it to tell you that yet. So you either have to remember you checked the box, you have to call one of my colleagues to ask if you checked the box, or you just fill out the beneficiary designation form again and check the box, and then you're covered. So you can always fill out our beneficiary designation form. You can fill it out as often as you want. And every time you fill it out, every new beneficiary designation form we get supersedes any previous beneficiary designations that you've made. Okay. And the way to make the advanced death benefit election is by going to, you can read more about it at acera.org/ADV. The shortcut to the form is acera.org/BEN. And all you're going to do is save the form to your device, fill out all the fields, check the box, print and sign the form, follow the instructions on the last page. Let me show you the form real fast. Okay, so like I said, all you do is go to acera.org/BEN, and that will pop open this PDF. We are going to upgrade this sometime in the coming months so that it's in DocuSign and you don't have to mess around with the PDF, but that upgrade is coming soon. And I recommend designating beneficiaries as soon as possible. Like if you are able to upload this to us today, your beneficiary will be designated as of today. So all you do is your first step is to save the form to your device. Click the download button, save it to your device. Don't fill it out in the browser, and that way you can save the fields. Okay, well what you type into the fields because the fields are typable. So you can type in your name, you can add in your, your other stuff, and and so you fill out all your information about you. You name your beneficiaries. The first section is primary beneficiaries. Your primary beneficiaries are the main people you want to designate your death benefits to. So there's two sets of fields here, so you can fill both of those out. If you need more, it gives you instructions somewhere in here on how to name more. Um, Actually, there's three sets of fields. Never mind. And then contingent beneficiaries, there's three sets of fields for those. Okay. Contingent beneficiaries are always good to fill out, and that is it's exactly like it sounds. If you die and we go to pay your death benefits, and it turns out your primary beneficiary also already died or died at the same time that you did, then we move on to the contingent beneficiary. Okay, then you get down to section four. All you do is check the box. There is no disadvantage to making this election. There is only advantages. So it does tell you there's no disadvantage to making this election. It does give you a link to read more information. So I recommend you just check the box. You do have to get your spouse's signature if you're married, or you're in a state registered domestic partnership, or you have an Alameda County domestic partner. There are on the last page instructions on how to submit the form. You can't sign it electronically currently, so it does give you five different options on getting this over to us, including electronic options. Okay, so that is how you make your beneficiary designation. Let me see what questions are there. And somebody's asking who qualifies as a beneficiary. Um, if you make the advanced death benefit election, anyone, any human, you can't leave a continuance like a survivor's allowance to a trust. So it has to be a human. Okay. And somebody's asking, does the child have to be a minor? They do not. So if you have children who are not minors, you can feel free to name them as primary or contingent beneficiaries. If they are a minor, there are extra instructions on how to name minors as your beneficiaries to make sure that you appoint a custodian. Can we elect our child to be our primary beneficiary? Yes, you can. Just remember that your spouse under California law, um, if they don't sign this and you elect your child as your primary beneficiary and you do have a spouse or state registered domestic partner, spouses and state registered domestic partners supersede um, anyone else that you might name as a beneficiary unless you name somebody else as a beneficiary and your spouse goes ahead and signs it. Okay. Yes. So the answer, your son can get a death benefit if he's an adult and you click the advanced death benefit election. That is the exact way to do it. And you could leave a lifetime survivor's allowance to him. If you don't have kids or a partner, you can choose anybody to name for a lifetime continuance. If you don't have anyone that you can think of that you would want to leave a lifetime continuance to, lifetime survivor's allowance, you can name uh, anyone else, anyone who's not a human. You can name a charity, or you could name a trust. So there's instructions on how to name charities, trusts, and estates on the form as well. So there's a link for that, and you could name them as well. If you don't have a beneficiary designated, whenever you die, we do a next of kin process. So we do have to pay out the benefits to somebody. If the person is not a U.S. citizen, that's totally fine. You can name them. Okay. Somebody's asking, is the calculation for the lifetime continuance the same for beneficiaries across the board, or are there different calculations depending on who we elect? Okay, so really quickly, the way it works is that if you do not choose the advanced death benefit election, if you don't check that box and you die as an active member, um, your let's say you have a spouse, your spouse would get a 60% of whatever your retirement would be calculated as of the date of your death. So essentially, they're getting the unmodified option. They're getting the continuance from the unmodified option. If you choose the advanced death benefit election, we assume that you want them to get the highest, and we will choose option two for you, which leaves them 100% continuance. So it's the difference between a 60% continuance and 100% continuance. So that's why it's important to choose the advanced death benefit election. And then somebody's asking confirm for lifetime continuance for advanced death benefit election, circumstances wherein it can be a trust. There's no circumstance in which you can name the advanced death benefit election is for naming people for the survivor's allowance only. So you cannot name a trust for a survivor's allowance. A beneficiary for a continuance for that survivor's allowance has to be a human with a lifespan. Okay, deferred. So that's about active members. Deferred members. If you stop working here and you don't retire and you defer you're deferring your retirement to a later date, and you kind of are in this middle category we call deferred members. If you were to die as a deferred member, you wouldn't get any of those options. There's no continuance option. You would just get your beneficiaries would just get a return of the employee contributions and interest. Okay, more death benefit info at acera.org/death. Keep your beneficiary designations current. You can always check them in your account on our website. Fill out that beneficiary designation as much as you want. And I do see that we're running slightly behind, so I'm going to kind of speed up here so we can get to everything. Okay, so next next topic, understanding career planning options. What I mean by this is when you stop working here, whether you retire from Acera or not at the time that you stop working, what are your options regarding your Acera account? I'm going to kind of divide that into two categories. The first is you retire. If you're eligible when you stop working here, you can go ahead and retire. Okay. And if you retire, you earn service credit right up until you retire. We will convert your sick leave on a 2-to-1 basis to service credit up to a cap. There's more info on that on our website. You can work after retirement for anybody you want. We don't care. We're going to pay you your lifetime continuance or I'm sorry, your lifetime pension. Now, if you come back to work for an Acera employer, you have two options. One, you can continue your Acera retirement payments. In that case, you don't earn additional service credit toward retirement. There are restrictions on that. Or you can pause your retirement payments, come back to work for one of our employers, and you do earn kind of a second retirement. And at the second retirement, we restart your first retirement and we'll add to it because you earned a second retirement, so your total payment will be higher. Okay. So if you stop working here and you are eligible to retire, and there's some question that you may come back to work for one of our employers, you don't have to not retire. You can go ahead and retire, start collecting payments so you're not missing out on payments. And then later, when you come back to work here, you can make the decision whether to continue your retirement payments or pause your retirement payments. Okay, so that's your first option, is to go ahead when you stop working here and start collecting your Acera retirement. Now, your next main category is that you stop working here and you don't retire from Acera immediately. You terminate before you retire, okay? And you're going to kind of have three sub options here. I'm going to label them A, B, and C, okay? A is that you become a deferred member, which means that you leave your contributions on deposit with Acera. You do not take a refund. And that means you're still an Acera member and you have options. You can take a refund later or you can retire later. I'll talk about that in a minute, okay? Option B is to establish reciprocity with a reciprocal system. Option C is to take a refund of your employee contribution account. So let me walk you through each one of these three options. Okay, so first off, option A. Let's say you become a deferred member. Well, that means that your termination date and your retirement date are not consecutive dates. Okay, so there's a gap in between them. It means that you've left your contributions on deposit with Acera, and because you're a deferred member, that still means you're an Acera member. Interest will continue to accumulate on the balance of your employee contribution account. No negative interest. People ask me what I mean by that. Well, Acera invests our money in a diverse array of investments across the world, we tend to earn a lot of interest, but occasionally we'll have one of our 6 month interest periods where we post a negative return. If we post a negative return in that 6 month period, we don't pass that negative return onto your account. We never take money out of your account if we have a negative return. Okay. So your money is completely safe. The balance only goes up. And I cannot think of anywhere that you can park your money that there's zero risk that has historically earned the amounts of interest that we have tended to earn over our history. And if you're interested in how much interest we earn, you can go to acera.org/interest, and we have our interest history there. You can retire later out of deferred status. One of the major reasons people might become a deferred member is you're done working here, but you're not old enough to achieve the minimum age for retirement eligibility yet. So all you need to do is stop working here, go do something else, and then when you achieve that minimum retirement age, whether it's 50 or 52, then you can retire from Acera and start drawing your lifetime pension. Or you could come back to work and earn more as an Acera member. Now, if the only reason that you're becoming a deferred member, if you're already eligible to retire, is you think you might come back to work, well, I already told you that you can just go ahead and retire, and you have two different options for coming back to work here later. So don't miss out on pension payments, okay? Or as a deferred member, you could be refunded at any time. So you could take option C later. You can take option A now and then take option C later. If you don't know what you want to do when you stop working here, you don't know if you want to take a refund yet, just don't do anything. Just become a deferred member. You can take a refund later at any time. There's more info at acera.org/defer. There's a list of good reasons to defer and a list of not so good reasons to defer. Okay, option B is to establish reciprocity with another retirement system. You can link many different California public retirement systems with Acera. We have reciprocity with many of them. Many of the cities in California, I think all of the counties, any agency that uses CalPERS, the state retirement system, as their retirement system, because some agencies are so small that they will use CalPERS. We have reciprocity with them, or California state jobs that use CalPERS. There's a full list at acera.org/reciprocity. Why would you want to establish reciprocity? Well, there's benefits. When you link Acera with another retirement system, or even multiple other retirement systems, you get some synergy among all of the systems that are linked together. The first benefit is that service credit in all systems combined gets you over the vesting and retirement eligibility requirements. So let's say you're a General Tier 4 member and you're age 52 and you have 2 years over at Contra Costa County and 3 years here at Acera. If you don't have them linked together, you're not eligible to retire from either of those systems. If you link them together with reciprocity, you are currently eligible to retire from both of those systems. The highest average salary you earn under any reciprocal system is used by all the systems when they calculate your retirement. So when you link systems together, each one does a separate retirement calculation. When you go to retire, you have to retire on the same day from all of them. So any other system is going to do their three-part calculation with your tier, your service credit over there, your age factor percentage, your service credit over there. And then when they get to the salary component, they're going to see in their system that there's other systems linked, and they're going to contact every system linked. And all of those systems, when they go to do your calculation, they're going to use the highest salary to do their calculation as well. So you earn more in all of the systems based on your highest salary that you earn in any of the systems. So that is one way to dial in that salary component of the retirement formula, Sarah's retirement formula, is, if you can't find a higher paying position within one of our six employers, you could go to a different reciprocal agency to find a higher position. And when it comes time for you to retire from Acera, when we do your calculation, we'll use that higher dollar amount in our calculation. Okay, and there's two more benefits. It could make your contribution rate lower and it could put you in an earlier tier. Okay. To qualify for reciprocity, all you need to do is four things. You have to leave your contributions on deposit with every system you're linking together. There can be no more than a 6 month gap between when you terminate one job and start the next. You can't have more than 12 weeks of overlapping service. What that means is that I recommend just having 0 weeks of overlapping service. So don't be on vacation leave here and start a new job elsewhere during the same time. Just they'll cash you out for your vacation leave here anyway when you leave. Just don't have overlapping service, and it will keep that it will keep the reciprocity system happy. And you have to retire from all of the systems on the same day. Okay. And somebody's asking for a list of counties for reciprocity, go to acera.org/reciprocity. Now, that's options A and B. Option C for if you stop working here and don't retire immediately from Acera is you can take a refund of the balance of your employee contribution account plus all the interest that we have posted to it between when you started contributing and when you're trying to take the refund. And if you do that and you're looking for a lump sum payment, you're looking for cash, you may lose up to a third of your money to taxes and penalties right off the bat. Or if you want to avoid the taxes and penalties, you can roll over that money into another pre-tax type of retirement account if you have one and avoid those taxes and penalties until you start taking disbursements from those retirement accounts. The penalties come from I think if you're younger than 59 and a half, you get penalized for taking cash payments out of a retirement system. These take time, 45 or 60 or more days. It's not instantaneous, and you're basically saying, cancel my Acera membership. I don't want the benefits. I don't want the lifetime pension. Don't want access to the healthcare benefits. Don't want the death benefits. I just want to take my money and go somewhere else. Okay. And that's totally your right. Just remember that if you're already vested, okay, so you already have the 5 years of service credit. Even if you're not eligible to retire now when you leave, you will reach that retirement age before you know it, 50 or 52. And then you can draw a lifetime pension. And when you start drawing that lifetime pension, we will already give you your money back within the first 3 to 5 years of drawing that pension in the monthly payments. So, in almost every case, if you start drawing your pension at 50 or 52, like you're vested and you take a pension versus the refund, over your lifetime, you'll make way more money. You'll have way more income and you'll have a guaranteed income for the rest of your life. So, when you sit down to do the math, take that into account. But you do have the right to take a refund of your pension. Okay, so moving into the last section, let's see. About 9 minutes behind, so I might eat up into the 457B time a little bit, but we do have a little wiggle room in there. Um, Somebody's asking CalPERS. You left CalPERS back in 2012. Can you still combine it with Acera? There can be no more than a 6 month gap when you left the first system and when you start your job with Acera. Now, if you did want to establish reciprocity, I think there may be a way where if you leave your job with Acera and establish again with CalPERS within 6 months, then you can link all that time together. But you wouldn't want I don't want to tell you the wrong thing, so I would definitely contact us, acera.org/contact about that. Okay, last topic, making a retirement planning picture. So we're revisiting the slide and we're taking a little peek into the future. We want to look at your possible retirement income when you stop working here and you retire. And again, financial planners will tell you that you want to achieve at least 80% income replacement. You want to replace at least 80% of your working salary with retirement income in these categories. Okay. And Gene Hilliard, our 457B expert, is going to try to get you pointed at 100% income replacement. Okay. We're just going to use 80% for this discussion, but I recommend, when you run the numbers, I'll show you how to run the numbers. Try it at 80% first, then try cranking it up. Crank it up to 85, 90, 95, 100. See what happens. Okay. So what are we going to do? How are we going to do this? How are we going to figure out if your Acera pension and Social Security get you to 80% income replacement, or if they don't, and if you have to save more? And if you have to save more, how much do you have to save? We're going to use technology for this. You don't have to do any math. All you need to do is get an Acera pension estimate, get a Social Security estimate. Okay. And somebody's asking 80% gross or net. I think gross. Okay, so you get your Acera estimate and you get your Social Security estimate. Okay, so again, to get the Acera estimate, you log into your account, you use that estimated benefit, you end up with this Acera benefit estimate PDF. Look at the unmodified option. Okay, so save that number. Then you go out to Social Security. You go to ssa.gov/estimator, or just go to ssa.gov. There will be a big button that says estimator. You log into your personal account on their website. Okay, that's the federal government system. It's separate from Acera. They have their own calculator. They'll give you estimates for 3 different years. It's actually changed a little bit since this. Now they have like a chart and a slider, but they still give you 3 different ages. They have age 62, which is the earliest you can start collecting Social Security. Then they have a middle age and an oldest age. Okay, but you can play with the slider and you can get estimates for all the ages in between those ages. So you print out their estimate or save it as a PDF. And what I recommend is to start off with, when you're doing this planning, target age 62 because it's the earliest age you can start collecting Social Security. And that means when you retire from Acera, you start collecting Acera's pension and Social Security at the same time. And that gives you a lot of retirement income to work with. So do scenarios for age 62 first, and then once you get a feel for it and you're considering retiring earlier, then you can try dialing it back. See if you can retire at age 60 and live off your Acera pension and your savings alone until Social Security kicks in. Okay, but start with age 62. So we're going to look at this age 62. It's about 17. Let's say 2,046 a month. Okay. So we'll just use these two numbers. The Acera estimate is $3,007 per month. Social Security estimate is $2,046 per month. Okay, so we have the estimates. We filled in 2 of the 3 items in the equation, but these numbers don't tell us a lot right now. It doesn't tell us how much income replacement we're achieving. It doesn't tell us if we need to save more and how much to save. So what we're going to do is take those numbers and plug them into a third retirement calculator that will tell us. There's a lot of different ones you can use. If you search retirement calculator on Google, it will give you a bunch of different ones. The best ones will allow you to plug in a pension and a Social Security amount, and it will tell you how much additional savings you need to do. I think all of these allow you to do that. I'm going to just walk you through the Vanguard calculator right now. The Empower Retirement Calculator is if you sign up for a 457B account, you log into your account, you can use their retirement calculator. And I think it will include your 457B savings as well in that. Okay. So I'm going to show you the Vanguard calculator, which used to look like this until today. I was looking at it this morning and they changed it up a little. It still works the same, but I'm just going to walk you through it on the website to show you how to do it. Okay, so what I recommend is going to acera.org, okay? And then if you look under members, this third article down, planning your future retirement income, it's basically what we're doing right now. Or you can just type in acera.org/planning. This is a full article that is a walkthrough on what I'm just going to do with you quickly right now. And also, one of the first things that you'll see is this video. This is a 20-minute video, and you can stop and start this. This is also a walkthrough of this process that I'm doing right now. Okay. So it takes you step by step. I'm going down to it, helps you get your Acera estimate, helps you get your Social Security estimate. So there's a link out to the Social Security estimator. Okay. And then you get down here and it actually gives you links to some of the calculators that you can try. I recommend trying a few of them because they'll all give you a little bit different number. And these are all approximations, okay? So we're just trying to get you close. We're trying to get you pointed in a trajectory. Okay, so this is what the Vanguard calculator looks like. What it's going to do is ask you some questions about your life and financial and retirement scenario. So you fill in the calculator with your numbers, it's going to tell you how much income replacement you're achieving with your pension and Social Security and whether you have to save more money and actually how much to save. Okay. So I'm just going to do a scenario. Let's say that this CRA member is 35 years old, and we're going to again start with a retirement scenario at age 62, just to see, just to see what happens. Let's say they have an $85,000 income per year. Okay. Then it's going to ask you how much do you plan to save for retirement for a year, or I guess how much are you already saving? Let's say it's zero. Let's say you currently save nothing for retirement. Perfectly fine. Okay, don't worry. Okay, we'll figure out if you want to save some in just a minute by using the calculator. Okay, and then you have step 2 here. This is asking how much do you already have saved for retirement? Maybe that's also zero. You have nothing. No worries. Okay, we're going to get you on that trajectory. This is asking what income replacement percentage you want to target. We're going to start with 80. So I recommend starting there. So you start with an age 62 retirement at 80% income replacement. See what it gives you. See how much savings it tells you you need to do. And maybe you can find some wiggle room in there. Then type in 85, type in 90, type in 95, type in 100. See what happens. Maybe it doesn't, maybe it says that you don't have to save that much more money to get pointed at 100%. It's always good to have a buffer. Okay, now this last percentage, this is probably you should put in somewhere between 2 and 7% in here. And what this is asking is the assumption here is that if the calculator tells you that you need to save additional money toward retirement, the assumption is that you are going to put that money, that additional savings, in a place that has the potential to earn interest. And you do that by investing your money. Um, and so we're not talking about where to invest it yet. We're just talking about like that you're putting it somewhere that has the potential to earn interest. So you have different options, and it's basically asking for your appetite for risk. If you put your money somewhere that's totally safe, like a CD, you might earn 2, 3% these days. Historically, those didn't pay that much, but these days, things are getting weird, so they pay a little bit higher. There's some high interest savings accounts that pay like 3.5%, that are FDIC insured. Those CDs are FDIC insured, so that might be your bottom currently. Um, I would say that 5% is kind of very is modest. 6% is kind of, you know, I would say 5% is conservative, 6% is like conservative, moderate, 7% maybe moderate. Sarah's own interest assumption rate is 7%. Um, and if you were to take your money, let's say, and you were to invest it in a 457B account and choose some diverse index funds, let's say, historically, those have yielded over long periods of time, probably around 7 or 8%. We don't know what the future will hold. The past doesn't predict the future, but markets have short-term ups and downs, but kind of the history has been that if you leave your money invested over the long term, you earn interest on the interest that you've already earned on the interest that you've already earned, and the power of compound interest kind of gives you an accelerated effect. And that percentage rate has hovered around 7%, kind of moderately conservative. So I'm going to do 6%. And where you save the additional money is up to you. I'm going to let the expert Gene Hilliard talk to you about that when he talks about the 457B accounts. But we're just gonna kind of be moderately conservative on this example, 6%. Okay, now the last two numbers. You put in your estimate from Social Security. In this example, it was $2,046 per month. Estimate from Acera was 3,007. And then I'm going to hit calculate. Okay, now it's showing me the results. And it's giving me two bars here. Okay. The top bar represents my retirement income. The bottom bar represents an estimate of what it thinks my retirement expenses are going to be when I retire. And the goal here is to make the bars even. The bars are not currently even. The income bar is shorter than the expenses bar. So what this is telling me is if this was my scenario where I was only relying on the Social Security and retirement savings income and no additional, I would not have enough money to pay for my estimated expenses. Okay. So the calculator, one upgrade that they just made like today is that what you can do is you can drag your retirement age out and see what the effect is of working longer um, on your retirement. So you keep dragging it, and you'll notice the income versus the expenses starts to get more even. But in this scenario, it doesn't really ever get even. Okay. So what it's saying is that you probably need to save some money. Okay. So let's add some savings. Okay, and recalculate. So I'm going to add $1,000 per year of retirement savings just to see what happens. And it's telling me that represents 1%, about 1% of my salary rounded. And all the other numbers are the same. I'm going to hit recalculate. And now it has added a little bar here for retirement savings. Okay, so now I will have some income from my retirement savings, but the bars are not quite equal. Okay, so I'm going to add some more. Let's see what happens if I add 3,000. Okay, I'm going to hit calculate. Now the bars are starting to get equal, okay? So there's some retirement savings there. And at this point, I could see what happens if I retire at an older retirement age and see if I could equal these things out. Okay, so now the expenses number and the income number are roughly the same. So if I was only going to save $3,000 a year in this scenario, I could get away with doing that and retiring at age 66. But I wanted to retire at age 62. So I'm going to dial it back and see if I can add some additional savings. So let's go up to 5,000. I'm going to hit recalculate. Okay, now my income is a little more than I needed. Okay, so maybe I don't need to save that much. Let's see what happens if I just equal it out just to figure it out. Okay, so I put in $4,500, and now the income is about 5,600 and some, and so is the expenses. So the bars are about equal. So what this is telling me is if this was my retirement scenario and this was my salary and I was targeting 80% income replacement and I was going to save an additional $4,500 and I was going to invest that somewhere where over long periods of time I have the potential to earn 6% per year, and these are my other incomes from Social Security and my pension, I would achieve 80% income, the 80% income replacement, and I would be able to have enough income to pay for my expenses. So this is the number, 4,500. It's saying in order to achieve that level of income replacement, you need to save 4,500 per year. Now that might sound like a lot. Whatever the calculator spits out might sound like a lot at first. Whatever it tells you, I recommend divide it by the number of pay periods in the year, 26 pay periods in the year, to see how much it would cost you per month, per paycheck, how much you would have to, how much room you would have to find in your paycheck. Okay. And in this example, you would have to find an additional $173 in your paycheck, which sounds a lot less than 4,500 per year. Now, once you get to that, I also recommend, if at all you're considering saving your money in your 457B account, you can save that money on a tax deferred basis. So you're not going to see a dollar for dollar deduction in how much you put into the 457 versus how much will come out of your take home pay after all taxes are paid. It'll probably be about three-quarters of that. So go ahead and multiply that by 0.75. And really, you only have to find about $130 in your take-home pay in this example. So the numbers are going to be completely different for you. So that's kind of the whole process is you get the estimates, you plug them into the calculator, and then you kind of get an idea of how to get pointed on the 80% income replacement trajectory or whatever trajectory you're targeting, okay? And if you go through this exercise now, okay, and you can see that you don't have to do any math, you just got to collect the numbers and plug them into the calculator. If you do this now and you begin that savings now and you adjust don't stop there. Like come back every year, every 6 months, do the exercise again, get the estimates, plug it all in again, see if you're still pointed at your percentage that you want. Um, I think you'll find that over the time between now and when you're targeting your retirement, if you continue to do this exercise and readjust your savings, you will find that when you go to retire, you will have achieved the income replacement amount that you are looking for and you can retire when you want. Okay. Now, maybe you can't find that much room in your paycheck now, but you can get started with as little as $20 saving in the 457B account right now. So I recommend starting there. And then once you get used to seeing that, you'll stop missing that $20 from your paycheck. Okay. Then you come back maybe a few months later once you don't miss it anymore. See if you can turn it up another 20. See if you can turn it up to 40. And keep doing that exercise until you get up to the 130 or whatever it is that the calculator is telling you. And then you will be pointed in the trajectory of income replacement. Then at that point, you might want to come back to the calculator, plug in instead of 80%, plug in 85%, and then increase the amount of savings and see if you can equalize them out, and then ratchet it up that way. So that's another way to do it. Or you could come in here and say, 62 is nice, but a retirement age of 60, that would be even nicer. You plug in 60, okay, and it will calculate it for you. Just remember that between whatever that age under 62 and 62, you're not going to be getting the Social Security income, so you're going to have a plan for that. Okay, I do have some more slides, but I'm going to turn it over to the expert at this point, who's going to tell you the nuts and bolts about saving the 457B plan. The 457B plan is one place that you can save your money. You don't have to, but it is a special type of account only for government workers that you can save money out of your paycheck on a tax-deferred basis. And Gene Hilliard who is our expert, has been hired for many years by Alameda County to provide this financial education to county employees. Now, if you're not an employee of Alameda County, don't worry. 99% of what he has to tell you is going to apply to you anyway. It's just that you'll have to go to your employer to sign up for the 457B account. But you all have access to it as government workers. Okay, Gene, are you there?
I am here. How's it going? Can you hear me?
Awesome. It's going good. Yep,
Okay, good,
we can hear
good,
you. Go
good.
ahead and share your presentation.
You got it.
And I did cut into your time a little bit, but do you think you'll finish about noon or a little bit
I'll finish
over?
it noon.
Okay.
Yeah, I'll finish it noon. Next time, just go for it. I can, because you're covering a lot of what I'm going to cover anyway, so I can cut it a little bit shorter next time. So,
Oh no, I feel like what I imparted is kind of the full amount of knowledge I have on this topic. And so yeah, I definitely want to hear from the expert.
you got it. You
So take it
got it.
away.
All right. Thanks for having me. Well, good morning, everyone. My name is Gene Hilliard. I'm Vice President Financial Advisor of Emerge Financial Group. We're a financial services company here in Oakland, helping our clients with financial planning. We do taxes, we do accounting. I'm sure you're probably thinking, well, what in the world does Emerge Financial Group have to do with Empower or deferred comp? Well, as Mike had mentioned, my firm was hired roughly 17 years ago to provide retirement planning, investment guidance, and also education. The county had the foresight to say, hey, in the past, we've had people that are, say, live in New York or in New Jersey who are flying in and meeting with our participants. They don't really understand the layout of the Bay Area, the expenses of the Bay Area. And so the county felt it's important that we have a subcontracting relationship with some folks that are actually from the Bay Area. So that's why I was hired, like I said, roughly 17 years ago. A little bit about my background. I've been in this business for roughly 23 years. Like I said, helping my clients create wealth, maintaining that wealth throughout their lifetime of kids and grandkids. I'm a retirement counselor as well, helping participants like you maintain your current lifestyle in retirement as soon as you possibly can, right? And one of the best ways to really make that happen is to invest in your deferred comp plan. And you guys are really, really lucky. I'm a little bit jealous in that you guys have a pension through ACERA. And if you stay with the county any significant amount of time, you're looking at possibly half your salary. So, when Mike talks about 80% or 90%, You're almost halfway there just through your Acera. All you have to do is cover that other 50% or 40% or whatever the number is through your deferred comp plan. So I'm going to spend a little bit of time talking about deferred comp, and hopefully we'll have some time to answer some questions in the end. Okay, so here are the key, let me move this over. Here are the key topics. We're going to talk about retirement income a little bit, benefits of saving through the plan, and updates. There are some significant updates in your deferred comp plan, which is also known as a 457B. So I need you guys to implant that in your brain. It's deferred comp, but it's technically under tax code 457B. And we'll talk a little bit about how to enroll. Okay, so let's talk about income. I think it's important, especially when you're thinking about retirement, you have to really get an idea of what you plan on doing in retirement. And then once you've determined what you're going to be doing in retirement, then we have to turn all of that stuff into dollars. Okay. So what are you going to be doing in retirement? Are you traveling? Are you going to spend some time with friends? Split some time between homes? Are you going to have a significant social calendar? So what exactly are you going to be doing in retirement? And I also want to point out that deferred comp is not just about retirement per se in your 60s or in your 70s. Some people use deferred comp to semi-retire. Wouldn't it be nice if you can retire at 55, right? Some of you, I believe, are maybe tier one. Some folks are tier two. Some folks are tier four. And there's a certain minimum age, but maybe you can work until you're 55 or 52, right? You have a pool of money that you can use with your deferred comp, and then you can go out and work and do something part-time to make up the difference to cover your bills. So it's not just, my point is, it's not just about retirement in your 60s. You could potentially, if you put enough money away, you could potentially retire in your 50s. But most importantly here is you have to have an idea of what you plan on doing in retirement and how much is that going to cost you. And as Mike had mentioned, typically financial planners say you need roughly 80% of your pre-retirement income to live a comfortable retirement. But I always say, if you start soon, let's shoot for 100, and then we can settle for 70 or 80 or 90. But I'd say for the most part, start at 80, like Mike had mentioned, and then you can ratchet it up as you progress throughout your career. So that's roughly how much it's going to take, between 70 and 90%. Where is this income going to come from? Where is this 70 to 90% going to come from? Well, you got Social Security. Mike did an excellent job of kind of explaining where to go to find out how much you're going to get monthly from at age 62, at age 67. Some of you may be in 66, and then also at 70. Are you going to generate some income from assets? Maybe you've inherited some money. I have a little bit of expertise of participants or people coming to me when they receive a significant inheritance and they're looking for some guidance. So you can visit with me. I can kind of give you some ideas of how to manage your money if by chance you get an inheritance. But some of you are probably have purchased some investment property now or have the aspirations of purchasing investment property, and maybe you're going to live off the assets. Income from earnings. I have no issue, no problem with folks doing a little bit of work when they're retired, right? I think it's important. Cognitive decline is real as you age. I'm 58 and I'm feeling it already. So working keeps you sharp. And so why not get paid a little bit of money at the same time to help you support a comfortable retirement? Okay. What are the benefits of the plan? It's easy. One of the best wealth building tools is deferred comp. Why do I say that? Because the wealthy consistently pay themselves first. Poor and middle class, we tend to pay our bills first and then we save, right? 9 times out of 10, you're probably not going to have any money left over after you pay your bills, potentially. Or you have this mindset of, oh, I need to have some money set aside just in case. But if I take the money from you first out of your paycheck, I'm confident many of you have come from humble beginnings. You can make a dollar stretch if you have to. So pay yourself first. Money comes directly out of your paycheck and it's invested. How much should you contribute? You can contribute a minimum of $20 or 1% of your salary. So I would encourage start there if necessary, but I can tell you that most participants, in my experience, invest roughly 10 to 15% of their pay into deferred comp. But if you need some assistance, you need some guidance in terms of what is the best number for you, please don't hesitate and reach out to me. Okay. Here are some highlights. As I mentioned before, actually, it's 1.5% is the minimum, up to 61%, but it is $20 a paycheck. Okay, so for 2026, the maximum is $24,500 if you are under 50 years of age. Okay, now you can't just write a check and say, Gene, here's 24,500, put that in my deferred comp. It's not how it works. Money must come from your paycheck. If you're 50 and over, in addition to the 24,500, you can invest an additional $8,000. Okay, bringing your total to 32,500 if that's something you're interested in. Because of the Secure Act 2.0 that was recently implemented, if you're between the ages of 60 and 63, on top of the 24,500, you can invest 11,250 on top of that. Okay. And then lastly, there is the 3-year catch up where you can invest $49,000 a year for 3 years prior to retirement. If that is something that you're interested in, please don't hesitate and reach out. I'll walk you through the process of how to make that happen. Okay, some more highlights here. Vesting, 100% of the money that's invested in deferred comp is yours. Once you leave county service, you have access to it. Okay, so there is no, oh, I got to stay with the county for 5 years or 4 years before I can get all of this money. No, the vast majority of the money that's invested, or actually all of it, 100% is your money. And I know a question is going to come up. Well, Gene, does the county offer a match in deferred comp or in this 457B? And the answer is no. The county does not offer a match. Okay, so, but don't feel as though you're being shortchanged because the county is investing money for your future in a SARA. So you're getting some free money there. And that's where there is a vesting schedule that's involved. Talk to Mike in a little bit more detail if you have some questions there. Okay. Investments. There's roughly 15 core investments available in deferred comp. So if you like index funds, there's something in here for you. If you like socially responsible investing, if you don't want to take on any risk, there's investments in there for you. We got small cap companies, medium-sized companies, large companies, international bonds. So a whole slew of different asset classes for you to invest in. Okay, so knock yourself out. Okay. What are the advantages of deferred comp, or one of the benefits is there's tax benefits. You can invest pre-tax. You can invest in the Roth version of deferred comp. Now, it's not a Roth IRA. Rules are different. It's a Roth 457B, or you can potentially roll over money into the plan. And I'm going to talk about that a little bit. So let's talk about pre-tax. So you can invest money pre-tax in deferred comp. It reduces your taxable income right now. So you get a built-in tax break. You pay the taxes in the future when you hope that your tax bracket will decrease. So if you believe your tax bracket will decrease in retirement, then the pre-tax version of deferred comp is for you. And the good news for you folks who, all things being equal, salary is about the same, and you tend to get a refund every year, if you invest pre-tax in deferred comp, very good chance your refund will increase because we're reporting a lower amount of income than in the previous years. So potentially you can earn more money in your tax refund, but check with your CPA, check with your tax advisor to confirm. Okay. But let's say, you believe that you're going to be in a higher tax bracket when you retire, and you would rather pay the taxes now. Well, there's a Roth version of deferred comp. Money goes into the account, you pay the taxes, grows and grows and grows over time. You don't pay any taxes on the growth. What's the catch? Well, you have to be at least 59 and a half. The account has to be opened up for at least, I believe it's 5 years. 59 and a half, 5 years. Then the growth of the Roth deferred comp is tax free to you. And as I mentioned, this option works best if you believe you're going to be in a higher tax bracket when you retire. Okay? You're in charge. You can set specifically what percent of your salary you're interested in or a specific dollar amount that you're interested in. It's completely up to you. You can increase, decrease at any time. You just cannot exceed the max between the two. Okay. So let's talk about investing. That sometimes is the hard part. There are three types of investors. You have a do it for me investor, you have a help me do it investor, you have a do it myself. You have a do it myself investor. First option is do it for me. You need some help. I'm not an expert. I want someone to just take care of all of it for me. Tell me how much to contribute, tell me how to invest the money, and then I'll let them do all the work. So that's an option that's available to you through the Fisher personalized retirement managed accounts. Now it's going to cost you a little bit more to participate in this program, but maybe it makes sense to you. All right, but let's say hypothetically you like the idea, but you don't like the idea of having to pay extra for it, and so you need just a little bit of guidance. Well, we have the option here of investing in Goalmaker, and I'll touch on Goalmaker a little bit. And then there's Fisher Personalized Retirement Online Advice. So you can go online, enter a little bit of information, and then they can kind of guide you. Uh, and then there's the Do It Myself investor. Say you're an expert, or you have some knowledge in the investment market, or let's say you have an advisor that you work with that's recommending a certain asset allocation. So that's fine. Do your homework, do your research. When you're setting up the account, just enter the percentages of the funds you want, and then you're off and running. Okay. GoalMaker is pretty much an award-winning asset allocation tool that I'd say the vast majority of participants use. You tell us what your investor style is. I'm conservative, I'm moderate, I'm aggressive. You tell us the year in which you anticipate retiring. I'm going to retire in 2040. I'm going to retire in 2030. Our models only go out as far as 2040. So if you're going to retire in 2040 or later, then you want to choose that model. But you have to tell us your investor style: conservative, moderate, aggressive. Tell us when you anticipate retiring, and what do you get? Fully allocated portfolio that has automatic rebalancing associated with it, and age adjustment. What is age adjustment? Well, as you navigate and you're starting to get closer and closer to retirement, the account gets more and more conservative, which makes sense. That's what age adjustment means. What is automatic rebalancing? So let's say hypothetically, your portfolio when you started in your career was 80-20. 80% is in stock funds, so a little bit risky. 20% is in something conservative, stable value, or some bond fund. So 80-20 is the appropriate asset allocation for you. And let's say hypothetically the market is doing well, stocks are going through the roof. Your account is now 90-10. That's entirely possible. The stock portion has performed so well, it's outpacing the bond portion or the money market portion of your account. So you're at 90-10. And so that is really out of whack for your risk tolerance. So what automatic rebalancing does, it sells a little bit of the stock portion and buys into the bond cash portion of the portfolio to make sure that the integrity of your portfolio stays intact. And that can happen automatically if you ask for it. We can do it once a year, once a quarter, but you tell us what you're interested in. Okay. Consolidating, so you can roll money into the plan. So if you have a portfolio at a previous employer 6 jobs ago, not earning a whole heck of a lot, consider rolling that money into deferred comp. I can walk you through the process. But most importantly, I don't think you should just do it just to do it. Reach out to me, have me research your prior employer plan to see if maybe it's better than Alameda County's. I have to say that there are a lot of folks are moving from San Francisco County at employer into Alameda County. San Francisco County's plan is far superior, in my opinion, than Alameda County. So I would probably tell you, no, leave it over at San Francisco County. But if you've worked at a nonprofit organization, really small companies, those those portfolios tend to be more expensive because they're smaller, and it may make sense to roll that money over. Okay. Flexible distribution options. All right. So this is not a 401k. This is not an IRA. The rule with those types of plans is that you have to be 59 and a half before you can access this money. Deferred comp is not like that. You don't have to be a certain age to access this money. As soon as you leave county service, it's yours. Okay. Um, that's really the big one. Just want to make sure folks are aware. And when you do retire, you can pull money out on an as needed basis. You can ask for money monthly. You just have to pay the taxes, assuming you're investing pre-tax. Okay. So let's talk about some of the updates. I'm sure many of you probably have already heard about these updates because I had a presentation earlier in the year. But if not, just know that there's something called in-plan Roth conversions available to you. The super catch-up contributions, I covered that a little bit earlier. That's when you're 60 to 63, where you can contribute more. There are some new Roth rules. As many of you are aware, loans are available in deferred comp. If you are a current employee, you can borrow 50% or $50,000, whichever is less. That option wasn't available to separated employees. It now is. So I want to briefly touch on that. And then rollovers. In the past, you had to be an active employee to roll money in. If you separated, you couldn't roll money in. They changed the rules. You can now, once you've separated or left county service, you can still roll money into the plan. Okay, so let's talk about the in-plan Roth conversion. As you know, this plan is probably 50 years. You can only invest pre-tax, right? We only offered the Roth feature probably 10 years ago, maybe a little bit longer. So there are quite a few employees that would prefer to maybe move some money out of that pre-tax bucket into the Roth bucket. So that's called an in-plan Roth conversion. That feature is available to you. So you can move, move money from the pre-tax bucket into the Roth bucket. There's certain rules that will apply. So if you're interested in something like this, reach out to me and I can walk you through the process. In the past, when you were 50 and over, and for example, here you can invest 24,500 and then the extra 8,000. In the past, that extra 8,000 catch-up contribution, you could have put that money into the pre-tax bucket. No harm, no foul. But because of the Secure Act 2.0, it now states that if your FICA wages, and that's your wages that pays into Social Security, exceeds 150, the 8,000 must go into the Roth version. You can't put it in the pre-tax bucket. So I just wanted to make sure everyone is aware of that, just in case you notice, say you're in the plan and you notice money is now starting to go into the Roth and you don't understand why. It's probably because the county had noticed that your income from the previous year exceeds 150 and that $8,000, that extra catch-up contribution must go into the Roth. So I just wanted to make sure folks were aware of that. And then lastly, the 3-year catch-up, that's the $49,000 a year for 3 years. That doesn't apply. So you can put all of that into the pre-tax bucket. But the $8,000 catch-up contribution and the 11,250 if you're 60 to 63, provided your income from the previous year exceeds 150, has to go into the Roth version. Okay. Loans are available for separated employees. You can borrow 50% or $50,000, whichever is less. You pay yourself back with interest. You can roll money from previous plans into deferred comp at your leisure. But as I said, reach out to me first. Let me confirm that it truly makes sense for you to roll that money in. and then I can walk you through the process of making that happen. Okay, so let's talk about how to enroll. To to enroll in the plan, you first have to go to AlamidaCountyDCP.com, AlamidaCountyDCP.com, and you're going to click on register. See where it says click on register. And once you've registered, you're going to click on I have a plan enrollment code. So click on I have a plan enrollment code. All right. And once you've done that, and matter of fact, there's a enrollment code. It changes roughly every 4 months, I believe it is. So I want everyone to write this down if you're not in the plan. The group/plan number is 525-127-01. So you're going to need to put the dash in there when you're typing it in. That's 525-127-01. And the plan enrollment code is capital J, lowercase a, the number 3, capital V, S is in Sam, lowercase, A is in Apple, lowercase, and then a capital X. So that's JAA3VSAX. So that is currently the plan enrollment code. So use that to sign up, and then just follow the prompts. Okay. This is a screen that'll pop up, putting your name, putting your social, putting your income, address, hit continue, and then move on, and then create a user ID and password for the site. Okay. So for those of you who currently are in the plan and maybe you've never created a user ID and password, I encourage you to do that. Just log in, click on I do not have a PIN, follow the prompts to register. If you're in the plan and you want to increase what you've contributed to deferred comp, okay, what you're going to need to do is you're going to need to log in here. Well, actually, go to Alameda County DCP.com. Go there. And then in the far right corner, you're going to click on Plan Resources. See where it says over to the right top, Plan Resource. You don't need to log in, but go into Plan Resources and then click on Payroll Modification and then follow the prompts. And you can do that online. Okay. All right. So where are we? How to get a hold of us? Just call 855-969-4572. You hit option 1 to speak with someone at Empower. Option 2, if you need to speak with someone with Alameda County, Darnell Williams, Victoria, I forget her last name. But if you want to speak with someone with deferred comp that works for the county, option 2, to schedule an appointment. Option 3, you can meet with Mark, which, by the way, for those of you who have met with Mark in the past, he just recently retired. So I need to update my screen here. But he's being replaced with Daryl Pitts. You can meet with myself. There's Dan and Jose who work for Empower. So you can call, or you can go to AlamidaCountyDCP.com, click on Meet Your Plan Representatives, and then our pictures will show up. And then you can just click on Schedule an Appointment. With Daryl, I believe you have to call his office to schedule. And with myself, Dan, and Jose, you can just click on I want to schedule an appointment. And on our calendar, you can schedule an appointment. For me, let's see, my virtual appointment days are Mondays and Wednesdays. And the Tuesday, Thursday, Friday is predominantly phone. Okay. So with that, I think I just barely made it. We're at, believe, 11:59. So I'd love to entertain questions. What is on your mind?
Awesome. Thanks so much, Gene.
My pleasure. My pleasure.